Yesterday it was up 2.5%. We had the likes of H&M really moving higher, more than 10% higher, in fact, in session yesterday. And so that was certainly an area of focus for us. So what does the market do today? Well, early signs are that we have travel and leisure moving higher as one of the sectors to watch. Basic resources also doing pretty well, and only a few sectors in negative territory. So broadly positive. Stock 600 up by 0.2% this morning.
Yeah, we should mention that Lloyd's of London is not only one of the highest index contributors, but one of the high percentage movers as well, higher by about 1%. We just had the CEO on talking about those record moves. They are, given just their maritime insurance, they're seeing a lot of that uptick in their numbers as well, not to mention, not to make kind of good out of a poor situation, but some of the costs around the Baltimore Bridge collapse, the Red Sea tensions as well, they are actually able to deal with that and not have to kind of shell out too much more than they had anticipated.
Yeah, he did say he thinks it's likely to be one of, if not the biggest marine insurance claim that we've ever seen. But specifically on their business, as you say, they've had a very good year in terms of 2023, and it was interesting. He was talking about that outlook. He says it's not a one-off. They expect to post, and they're in a position to continue to build on that in 2024. Absolutely right, of course, Anna, to focus in on the top sector being basic resources. We have seen a bit of strength coming through for the commodities space this morning. Iron ore prices having skirted with that 100 level are at 101, up just 0.5%, and Brent oil is also high, as is copper, just by a smidge. So a little bit of movement in the materials, the basic resources space, the commodity space, lifting basic resources. So that's playing into, of course, what we're seeing on the FTSE 100 that is exposed to some of those miners. The FTSE 100 up 0.3%.
Yeah, the FTSE is a little stronger. We have that, modest sense of improvement across European stocks today. It's kind of broad-based, isn't it? As we've been mentioning, a lot of these sectors in positive territory this morning. Only, as I was mentioning, just a couple were moving lower. In fact, 3 sectors moving lower. And the US futures picture, though, looks broadly unchanged. Just a word on the basic resources then. The best performing sector up 0.8. Struggling for interesting things to say about this market this morning.
Yeah, no, that seems to be the story. You got some of the heavyweights moving higher as well. I just want to quickly correct what I said earlier. Lloyd's of London is not listed. Apologies. Looking at Lloyd's Bank instead. So you are actually seeing one of the banks higher as well. Barclays, for example, trading higher as well as is BNP Paribas. So you are seeing perhaps a rate story. I'm curious if that's kind of some sort of reaction on the little slight tick up higher in yields we got off of the Waller comments, stateside, but also in Europe as well. Again, it feels more like a macro story that's reading into some of these stock stories.
It's interesting. There was that red headline earlier on about China and Australia being on better terms around wine. And, you might not see there's much direct read across from that into commodities, but the fact that basic resources do trade around sentiment towards China and global trade, and as well around metal prices, we don't see a great deal. We see a bit of upside on iron ore this morning, so it could be that.
So Australia produces this higher grade iron ore that China's reliant on. So they never cut off, they never shut the doors to that input, but they did certainly put the constraints on in terms of other trade inputs from Australia. You had the Labour government come in, the relationship has thawed, and you're right, in terms of the symbolism, it's important. Of course, it's important for the domestic wine industry of Australia. It was a massive market. It was the largest market, China, for the wine industry, so that's important for them. But it tells a bigger story about China, at least trying to find areas in relations with some of its trading partners to ease some of those tensions and to kind of put a floor, at least, under those relationships.
We found something interesting to say about this morning's market. Better mood music around China.
Thank God Tom McKenzie was here, because what would we have done otherwise?
Australian wine and China.
Tom's expertise, clearly. Well, let's go from the micro then to the macro story, because we're talking about these individual European earnings stories. Is there more upside, given that in this last quarter was the last day of the quarter? We actually already saw the stock 600 hit that record high. Take a listen to what Goldman's Sharon Bell had to say on that earnings story. She recently just upgraded her forecast for the index.
In Europe. It's not that you don't get any earnings growth this year. We do have a little bit of earnings growth, but it's kind of low single-digit earnings growth this year. It reflects the fact that the cycle is going to be a bit anemic, even if you do see some recovery. We're looking at less than 1% sort of GDP growth for Europe this year. So a little bit of earnings growth, but quite anemic, really, and most of it is valuation.
Sharon Bell there of Goldman Sachs talking about us. Now we're going to get a little bit more context here. Beate Manthe, head of European Equity Strategy, joins us coming out of Citigroup. Beate, you and Sharon both upgraded at the exact same morning, and we just happen to have Sharon on set. But what I thought was interesting is that your reasonings were so different. She was talking a little bit more about valuations, et cetera. You were talking specifically also about the earnings story and the earnings growth. EPS, I think, was one of your standouts. Walk us through why you're so bullish on European stocks right now.
So we've been very bullish on European stocks already before the upgrades that has just happened. But so we've been highlighting the balance of risks improving and this early cycle environment, potential further broadening in the market that should be really conducive of cyclicality, and not only Europe, but markets that have more cyclicality within their sector weights. But the reason we coincided with Sharon is probably she was thinking about the very dovish Fed encouraged us, and I'm pretty sure that was the trigger for her upgrades as well. So basically what we've heard, don't worry about the rates, we'll cut the rates, the economy is looking okay, we are upgrading the forecast, and we don't worry about inflation so much. So what more do you need for cyclical markets than that? That is a pretty good setup. And add to that a weakness in the dollar and a strength of the local currency. It's a pretty good picture. Now, on earnings, I agree. If you compare European earnings to the US earnings, of course, they are much lower. So our previous EPS forecast was for 3% growth, very low. Now we got encouraged by continued upgrades from economists. Yes, growth is going to be below 1%, but every month is a bit better than we thought it would be. And that, of course, feeds into my top-down models. So now I have plus 6% EPS growth for Europe. And we've been arguing for some time, markets have been pricing in, not so long ago, a contraction in EPS, and now the market is pricing pretty much in line with our top-down forecast, which is slightly below the analysts.
It all makes sense, except for that very first thing you said. The early cycle is what you call it. We actually just had Jerry Fowler over at UBS join us this morning, calling it a late cycle dynamic, but still saying that you were seeing value and cyclicals kind of outperform. What is the indication to you that we are early cycle and not late cycle?
So look, it's been a very desynchronized cycle. You could almost argue, I would push it even further, we don't have a cycle anymore as we've been used to, right? But in Europe, of course, in the US it's a different story. In Europe, we are coming from very subdued growth environment, flat GDP last year. EPS actually contracted by 5% and by double digits, excluding the strengths in the banking sector. So it's been a very bad underlying year for fundamentals. Therefore, it's easier to argue that we are coming up from low levels, central banks are cutting. This is, for me, early cycle dynamics for Europe.
So a very strange cycle. And what do we know about the level of concentration that we're seeing in European stocks? Because you've mentioned this in your notes, Beate. I think it's interesting. We talk a lot about too much concentration, or some people don't think too much, but just a lot in the United States, in the S&P, for example, or even in the NASDAQ. But we don't talk about it much in a European context. It's not driven by the same sector, is it? By tech? I don't imagine so. So what is driving that concentration in Europe?
So what is very interesting is that markets around the world went up strongly year to date, but through narrowing, so through concentration into a few stocks and sectors. And when markets narrow, they tend to narrow into growth. So in the US, it would be mostly tech. In Europe, it would be luxury goods as well on the top of tech, and more recently, even European banks. But we've had this concentration for 2 months. Concentration doesn't mean that the market has to come down off the cliff, right? So actually the very bullish positioning in the US has just come off at the beginning of this week without the market collapsing.
So do you expect that to? Do you expect the European market to broaden?
So our base case for this year was for the continuation of the broadening, just as it happened in the fourth quarter of last year. Of course, this narrowing was very unusual for Europe. Hardly ever happens in Europe, happens much more often in the US. So a more natural environment for Europe to outperform is really through broadening. And we are starting to see very tentative signs that this is starting to happen right now. So yes, broadening going forward.
Beata, Kriti went to your first answer. I want to go to your first answer as well, because you talked about the dovishness coming through from central bankers. You can look past and we can become less concerned about inflation. But is that the message that we're getting from Chris Waller? Is that the message we've had from Raphael Bostic? It doesn't seem so. Does the message from those voting members of the FOMC challenge that view?
I think we are going to have lots of news flow that will be challenging the view for sure. But we
you
really
don't get a weak dollar in that environment.
Yes.
You don't get a weak dollar in that environment. I mean, if Chris Waller is our new guiding light, then we're not looking at a weak dollar.
So first of all, we really focus on what the Chair Powell has said, right? And what the dots are telling us. So the dots stayed the same. That was encouraging, and that was always the risk they would come lower. So I think this is what the markets leaned onto. Now, on the dollar, we have a bit of the weakness. I think the risk on environment it's enough for equities outside of the US for the dollar not to strengthen further. So we do not have huge weakening in the dollar, but some over the next 2 quarters or so.
Okay, you're overweight continental Europe and emerging markets. You're underweight the UK, Beata. How does that, does the UK not have a cyclical, you favour the cyclicality of this market. Does the UK not have a role there?
It does. 50% of the sector weight comes from cyclicality, but it's very skewed towards commodities and especially the energy sector, while another 50% is purely defensive. So it's a very interesting and unique market from that perspective. So what the UK really needs is for commodities to start picking up. This will be a better setup for the UK market, for the FTSE 100.
Does that not eat into the bottom line, though, just given that there is that dependency? For example, hypothetically, for I think the very first time in months, we've heard JP Morgan float the idea of $100 oil, for example. It's not their base case, but they said it's a possibility in kind of the worst case scenario. Does that kind of spook you in any way in terms of the bottom line for some of these European companies?
So $100 could be a risk, especially for the inflation, right? Circling back to the central banks. It's been coming up gradually, mostly because actually the demand around the world is better. So it's a lead indicator that actually the global growth is not so bad. And of course, it's a function of some supply constraints as well. It all depends how it goes up, right? How fast and to what levels. But a bit higher oil, I don't think should be a problem at that point if the growth continues to pick up. Economic growth.
Yeah. I want to ask about the significance of real wages in 2024, Beata. Is this an upside risk for growth, for all kinds of dynamics within the European economy, maybe? We saw the UK retailer Next talking about this some time ago. Today, we got H&M numbers yesterday. They were strong. JD Sports numbers seem to be strong, as if there's something propelling these retailers at the moment. And Next certainly was talking about the real wage story. That's just very UK, but that seems to be a conversation we're having in other geographies as well.
So wage growth is always the risk for inflation and for the central banks again, but and could put some pressure on margins. But as long as earnings pick up or don't contribute really proper margin pressures, you only get when the earnings collapse, right? We don't see that on the horizon at the moment, but definitely a risk. Absolutely. Let's not play it down.
A lot to digest. We've thrown a lot at you. Beata Manthe, head of European Equity Strategy over at Citigroup. We thank you so much for joining the program. She's talking a little bit about how do you look at some of the even concentration risks, how you look at some of the indexes. Well, I'm going to put my Guy Johnson hat or Guy Johnson tie on perhaps today and look at the sensational six, his sensational six, where he likes to look at kind of the bigger heavyweights, the kind of sectoral picture that we really look at today. It looks like it's all green on the screen except for Novo Nordisk, which is interesting given that we were talking about that margin story that they potentially are selling a drug for about $1,000 per injection that could be made in about $5 according to one medical review. The rest of the heavyweights, LVMH, for example, ASML, even Schneider Electric, which we had Jerry Fowler on earlier talking a little bit about the AI read-through there, all higher by over 0.4%, leading the index higher as well. So that is your quick check on the sensational stocks. Let's get a couple more sensational stocks here. Joe Easton monitoring those very, very closely. Joe, walk us through it.
So the most sensational ones in the UK at the moment are in the retail space. Both JD Sports and AO World gaining. Both of them are recovery stories. JD, we had in stocks to watch. They have reiterated some of their top-line guidance and a bit of a relief, seeing as we had a massive drop from them in January. The sales are providing some support in terms of the American sales, where the strength seems to be. The UK actually looks pretty weak in terms of the profit guidance. That was up 17% at the open. It's come back down to 8% now. In terms of AO World, this is white goods, dishwashers, fridges, that kind of thing. They've had a terrible run, but again, it's more about no downgrade to profit, so therefore some relief in the stock coming up 13% this morning. We'll take a look at the chip stocks. We had that big warning from Soitec, and that one is getting absolutely slammed over in Paris. It's down 11%. It was down 15% at the open. Much worse than expected, according to analysts at Morgan Stanley. And it is in the iPhone and smartphone area, semi-supplied into there. So we're actually starting to see a bit of a read across now coming into some peers. Varta in Germany, they make the little batteries that go into AirPods, and AMS, they also supply iPhones, as does SD Micro. All of those coming down, a bit of a read across despite that positive update from Honhai over in Asia, the big iPhone supplier. In terms of deals, we've got the latest UK takeover. This company, Spirent, it makes equipment for the telecoms area. They've got a second bid, previously agreed to take over, and they've actually got a new bid above 200 pence a share, and that stock gaining 10%. Casino, that's in and out of a trading hole. It's resumed trading after a long period of suspension. The takeover by Daniel Krasinski has been finalised. It's very, very messy. It's down 50%. It will take a while to understand what's going on there, but it is a dilution of shareholders following that takeover. And Embracer, this is over in the video game space. They're doing a deal. That stock was up around 8% at the open in Sweden, but it is actually coming down a little bit now, doing a $460 million deal with Take-Two in the US. Finally, we're keeping on the theme of Lloyd's of London insurers. We've got an upgrade for Score, very timely, given your interview just now. A hard market, strong pricing in the Lloyd's of London market means Score gets an upgrade at HSBC, and a lot of focus on that given the events of the week. That stock up 3.5%. HSBC upgrades it to buy.
Okay, Joe Easton, excellent. Thank you very much indeed. And some of the stocks on the move for us this Thursday morning. Coming up, the world's biggest banks quietly hang on to carbon-intensive clients, exposing cracks in the world of climate finance. That story is next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
DOJ or other authorities
Could face bigger challenges.
was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Welcome back. This is Markets Today. 20 minutes into what feels like a bit of a sluggish session as we head towards a long weekend here in Europe and also in the United States. But we do have some upside on European equity markets, just up 0.1%. The German market underperforms. The FTSE outperforms. Retail, the best performing sector, as we saw yesterday. Some of those retailers doing pretty well. That seems to be a bit of a theme of the week. Time for your Bloomberg Big Take story now this morning. The world's biggest banks are quietly hanging on to carbon-intensive clients because of what they see as unrealistic demands from regulators and civil society and the threat to their fees, of course. Joining us now is Bloomberg's Alistair Marsh. Alistair, the fees, we're always going to get into the story somewhere, but it is to do with other things as well. And you've got some really interesting ways to illustrate where this story is going. But let's start with, it's been 3 years since most banks made commitments around climate. It's been a big focus for the sector. So what progress has been made?
Well, in the real world, emissions have gone up year on year, every year, to record highs, and banks continue to funnel billions of dollars into fossil fuel clients. So you could draw your own conclusions that the energy transition is not going that smoothly. And even if you look at what recently the CEOs of some of the big oil companies, the Exxon and Aramco, were saying, is that actually we need to put more money into oil and gas. We're going to be needing to rely on oil and gas for a lot longer than we'd thought, and we need to keep pushing money there. And that puts banks in a bit of an awkward position because they've come out with these climate commitments. They've said we're going to get to net zero by 2050, but actually the progress has been very slow. Some could say that the expectations were too high for banks and what banks could deliver on, but so far progress is not that much to show, really.
Can you connect the dots for us, though, how a bank gets involved in energy transition? I can't even understand that relationship.
Well, the price tag of the energy transition is like $5 to $10 trillion every year. That's the money that's needed to wean us off of fossil fuels, to build a kind of low carbon energy system, to build low carbon transportation, aviation, steel, cement, all the things that kind of make up our economy. We need to get off a fossil fuel base onto a kind of clean energy base. And that's going to require a lot of money. And the governments don't have that money, or most of that money needs to come from the private sector, from banks and from investors. And that's kind of the role that they play. And they've pledged that they will support that transition and that they will align their lending portfolios and their financing businesses with a 1.5 degree outcome with net zero. And that sounds easy on paper, but in practice it turns out to be fiendishly difficult, not least because of what I just said about emissions keep rising, and we're just way off track globally for hitting net zero. And so those commitments look a bit like pie in the sky.
And that tension kind of bubbled through in one particular meeting. And
yes.
This is some colour that is woven through the Bloomberg Big Take of the day. And it focuses on a UBS banker.
Yes, so there's a UBS banker called Judson Berkey. He essentially is their main guy for sustainable finance regulation. And there was a meeting in Tokyo held by the Financial Stability Board, which is a group of global regulators. Representatives from the Fed were there, the ECB. And he basically said, you regulators, your expectations of banks are way off track. You're asking us to align our lending, our portfolios with a 1.5 degree world. But the world itself is on track for 2.8 degrees or more. How can you possibly expect us to align with 1.5? It's ridiculous. And the way banks banks could do that, but if they were to do it, they'd have to basically divest all of their big clients. You could deliver a portfolio decarbonisation, but that's not helpful for real-world decarbonisation, which is what we need.
Right, and I guess this takes us into the question of fees for banks, their clients you mentioned, and who they compete with, because it's all very well. It's one thing if banks decided to do that, but then they would only hold the power to drive change, I suppose, if they were the only source of capital, the only source of funds. Step forward the private sector, the private credit sector. There are other places that businesses can go to get funding these days, and banks are going to be acutely aware of that.
Exactly. There's a big argument that comes from the banks that says if we divest from our heavy carbon clients, there are plenty of other people that can step in and take over from us. And we actually, because we've made these commitments, are kind of on the hook for having to deliver on them and are therefore more likely to push those high carbon clients to decarbonize. Whereas if you then have those same loans or that same financing go into the private markets, where you have perhaps lenders with less scruples when it comes to climate, or certainly have not made those commitments and perhaps are less caring, shall we say, on such topics, well, that can allow for emissions to grow in the private markets with less clarity, less transparency, and less kind of, no one really holding them accountable. And so that's a big problem here, or potentially a big problem.
Alistair, how big is our little violin on this when it comes to the banks? I mean, they made this commitment. We bring out the tiny violin for the bankers. They made these commitments.
They did, yes.
Right? They made these commitments. They're not naive. They're smart individuals, men and women, working through this.
Yes.
They made the commitments. Why they're suddenly doing the hand-wringing now? The other question is, there has to be a point where you make the cost of credit more expensive for the carbon-intensive industry, you make it cheaper for the renewables, and that's got to be part of the process.
Yes, but a lot's happened since they made those commitments. So they made most of those commitments with the 2021 era. 2022, we have the war in Ukraine, the energy crisis that's come. And so the assumption that oil and gas was going to go away or was in terminal decline, that's basically, that doesn't exist anymore. Those clients are profitable, very profitable. It's very hard to say, oh, we don't want to bank ExxonMobil anymore. There's no banking CEO willing to make that kind of move. And so, yeah, we're in a very tricky position where there's a lot of money to be made on fossil fuels, but we also need to drastically move. If we had to have any chance of hitting the 1.5 degree target, action needs to happen today. So there's this real tension.
Bloomberg's Alistair Marsh walking us through that tension that we're seeing in the banks with the energy transition. We thank you so much for bringing that to our attention. Coming up on the program, we speak to Wizz Air CEO and co-founder Joseph Varadi on his outlook for the airline industry, travel, and more. It's a conversation you don't want to miss as we talk about the demand going into the summer season, the inflationary pressures, and of course those supply chain issues that you were seeing on both sides of the Atlantic. All of that and more coming up next. Stick with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
So it's been a monster rally. That rally was mostly fueled by adoption, right? With the ETF, it made it very easy for people in the U.S., institutions and the wealth channel, most importantly, to access Bitcoin for the first time.
That was the Galaxy Digital founder and CEO Mike Novogratz on the Bitcoin rally. Certainly, it's been a really strong quarter for Bitcoin, for a host of other assets, for gold as well. The focus of a lot of our conversations this morning, Chrissy, has been around supply chains, and we're going to go into another conversation where that is important. We spoke earlier on to the CEO of Lloyd's of London, and he was talking about the impact on the insurance sector of one big supply chain issue, and that's the collapse of that Baltimore Bridge.
Yeah.
But supply chain is certainly something that's really dominant when you think about what's going on in the aviation sector right now, be it engines or the supply of aircraft.
It is, and then also, I mean, dare I say, it actually connects to the Bitcoin story and the investing story here, because some of those inflation concerns are actively driving the market. There is a fundamental connection between inflation and alternative assets in private credit and in private equity, in Bitcoin, not to put those all together. But the inflationary story is important because take a look at where all the uptick is coming from. It's coming from demand that hasn't gone away, supply chain points that you mentioned, and a lot of that, at least in the United States, if you break it down into the nitty-gritty, it's coming from airfare.
Yep. Yes, yeah, absolutely. So airfares have been certainly playing their part in that inflation story. Let's get into a conversation about the inflation, the aviation sector then now. We're joined by the CEO of Wizz Air, Joseph Ferradi, who's passing through London this morning and with us. So very nice to speak to you. It's nice to have you with us. Let's look ahead to the summer. I know we've got all these supply chain issues to talk about, and we'll get to that. But I just wanted to have a moment to think about what the summer looks like, because I know, you'll have people, network planners and computers all focused on how strong bookings look for the summer. I was looking at your load factor over the last few months, and it did seem as if it had dropped year on year, but I know you're growing. Should we be concerned about that load factor drop? What's going on there?
No, not at all. We see demand being very strong and intact, and people want to fly. To be honest, I think demand is a function of economic prosperity. I think the world is still doing relatively well. Of course, we always want it to be better. So there is nothing wrong with demand. The challenge to the industry comes on the supply chain side.
Okay, so let's go there then, shall we? Because that's clearly important. Let's start with the supply chain stories that do impact your business. And this is, of course, around the A320 family of planes grounded due to Pratt & Whitney engine issues. Can you give us any update? And thinking about the summer, is the summer under threat at all because of the lack of availability of these aircraft?
So at the moment, we have around 20% of our fleet grounded as a result of the Pratt & Whitney GTF engine inspection cycle. We try to mitigate that issue by extending existing aircraft operations, taking market leases. Also, we continue to take new aircraft deliveries. So as a result of that, we are planning on flat capacity year on year going into summer. So I think we have created some protective layer with that regard. But this is a significant hiccup in the industry, unexpected. But by now, I think we are all fully on top of that. We have plans, we have models, we have all sorts of compensation schemes in place, and operationally we are processing the issue. It's going to take us a year or two to fully go through this cycle, but I think we are on top of it.
What's the most up-to-date time frame you're looking at for resolving the Pratt & Whitney engine issue?
This is not going to go away too quickly. I mean, we are talking about two types of issues. One is the engine technology is a brand new, groundbreaking technology. As a result, you should be reasonably expecting some childhood diseases, and I think we are going through that cycle of childhood diseases. And on top of that, there was this industrial hiccup of contaminated materials, the so-called powdered metal, which needs to be corrected, and parts are being replaced as we speak. Both lines, I think, will come to an end in the next 18 to 24 months.
What is the Boeing impact? You're exclusively with Airbus, for now at least. The Boeing going through, of course, these momentous challenges, but it ripples across the sector in terms of the ability to churn out planes, to get planes to airlines. The impact on you as a business as you look ahead from what Boeing is going through, their travails.
Yeah, first of all, we are happy to operate Airbus. We like the Airbus planes, and we took a strategic decision why we were going for Airbus. Having said that, we have an interest in a very strong Boeing. We want a competitive industry because competition drives economic efficiency in the industry, and it drives innovation, and we need both going forward. So we want to see Boeing to recover from this, to become solid again, and be a quality player in the industry.
You talk about this kind of interest and ramifications for the broader industry. Talk to us about the capacity crunch there. Where's the bigger risk factor? Is it that demand has exploded in the way that it has, or is it these supply crunches? What's the bigger hurdle for you?
Yeah, to be honest, if you look at demand on a global basis, I mean, the whole industry globally is basically back to COVID level. So I don't think that this is the explosion of demand globally. It is the explosion of the supply chain globally. This is what's affecting the operations of the industry.
But that's pushing the airfares higher as well, and you're seeing that on both sides of the Atlantic. Talk to us about the airfare picture. When do you, as a company, address that or pull it down in line with the inflationary pressures that we're seeing?
Yeah, so basically, airfares are the function of supply and demand, and if supply is contained, obviously this is going to make an upward push on airfares. Our business model, however, is to make sure that we derive the most economic efficiency from our operations and apply that saving to the consumers, because we are still stimulating the market. I mean, let's not forget that in the United Kingdom, it is a fairly saturated market, but you go to countries like Central and Eastern Europe, you are still stimulating first flyers. 30-40% of our passengers are first flyers. They just flew first time ever in their life.
Wow. That's quite the experience. I just want to go back to some of the supply chain issues we were talking about with regards to Boeing, and you're saying it's important to have a strong Boeing. I find that interesting, given you don't use them as a, not a customer, as Tom said. Why is it important for you then, if you're not a customer of Boeing, that we have a strong Boeing in the marketplace?
Because I don't want anyone in this industry to monopolize its market position, because this is going to push prices up on the airplane, and it will slow down innovation. I think we need both. We need to have good assets coming out of the production line at reasonable price, and also we need to innovate this industry. I mean, we have the carbon challenge, and we need to make sure that the investments are put up properly, and that is an innovative force driving the industry.
So you don't want Airbus to put up prices? You don't want any of your suppliers,
maybe? Of course I don't want.
To put up prices. Is there, to some extent, an argument that maybe you benefit, though, if Boeing customers are not able to get hold of their planes, for example, Ryanair, and you're in the same markets as them to some degree in various geographies? So do you benefit from their inability to get hold of the aircraft?
Look, if there are any benefits coming out of the situation, we'll take them. But we are in the long-term strategic game here. The interest strategically is to have a strong Airbus, a strong Boeing, strong players in the industry, operating properly and delivering the right quality of products to the market.
Safety and critical quality issues, obviously in focus at Boeing. Are you completely and 100% reassured that Airbus has none of these issues? How confident are you in Airbus's ability to turn out quality aircraft?
We are. I mean, we are deeply into the Airbus system. I mean, just look at it from this perspective. Every year, we take roughly around 40 new aircraft deliveries. So we live and breathe together with Airbus. We understand their quality system, we understand the aircraft, and we are exposed to new aircraft deliveries on a continuous basis. We are very confident.
Regulators are on it.
Regulators are on it. I think EASA is doing a good job. Airbus is doing a good job. I think they are making the necessary investments needed in quality controls. I have full confidence.
Full confidence, but is there something else you'd like to see from the regulatory authorities in terms of ensuring that safety and ensuring that consumer confidence as well?
I think what we need to have, and maybe this is what has eroded over the last few decades, that due to the consolidation of the industry, the relationship between the regulator and the manufacturer became somewhat more cozy than what it should have been. These two lines must be totally separated out. The manufacturer must control internally quality of their products, and it has to be scrutinized and oversighted by the regulator in a separate manner, and those things should not be overlapped.
Okay, so that's the regulatory story. Away from the supply chain issues, there's something else I wanted to ask you about, and that is the way that we're sort of almost going back a few decades in the sense that some consumers want packaged holidays again, it seems. We've been writing about this at Bloomberg, and I know others have as well. But EasyJet is making profits in that area. Ryanair has deals in place to sell, packaged holidays. With cost of living crises in various places, it's focused consumers on knowing exactly what they're going to have to spend up front. Are you doing anything in that space to make money on that front?
I think we are seeing conflicting trends, to be honest. I mean, there may be a trend for package holidays, and there is another trend for unbundling, and people want to pick their choices, whether that's a hotel or logistics or airfare. We are essentially enabling them to do both, depending on consumer preferences. If people want to package up, they can do it on our website. They can do their own holiday package. If they want to buy various products separately, they can do it too.
All right. A lot to digest there. We thank you so much for joining the program. That's Wizz Air CEO and co-founder Joseph Virati joining the program this morning. Coming up, with Germany set to partially legalize cannabis for personal use in the coming days, we're going to discuss the opportunities for the commercial market. That conversation next. Stick with us. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. It's 8:43 this Thursday. The Markets Today show, of course, continuing to keep across these markets for you. The European benchmark is actually up 0.2%, so building on 3 straight days of gains. You've got 4th straight day of gain in progress right now. Fresh records set yesterday. It looks like we're going to add to that today. The FTSE 100 currently up 0.3%. The commodities lift coming through slightly for the FTSE 100. Over in France, the CAC 40 also gaining 0.3%. And across your sectors, quickly having a look on how things are shaping up. Consumer products, energy, food and beverage, all at the top of the list in terms of what is happening. Travel and leisure, I should say. In fact, top of the list, gains of 0.8%. Consumer products are up 0.7%. Bottom of the list is construction, off by 0.4%. S&P minis are flat. Nasdaq futures are flat. Again, fresh records on US stocks yesterday, taking a bit of a pause, it seems, today. Let's get to the banking space now, where UBS has cut its bonus pool for last year by 14%. 14% after a tougher year, of course, for deal makers and traders. This as the Swiss bank increases its cost-saving targets amid the integration of Credit Suisse. Annual profit came in at a record $27.8 billion. Let's bring in Bloomberg's Tom Metcalf then, who leads our finance team, for the details on this. Tom, Amotti's pay, Sergio Amotti's pay in focus. What does that number look like? Where does this rank among banking executives?
Yeah, it's sort of around the 15 million euro mark, which puts them right at the top of at least among the main European banking CEOs. As we know, when you compare that to US bank CEOs, it's relatively thin. You get someone at a Goldman or a Citi getting paid north of $25 million a year. But it just goes to show, I think, obviously, the size and scale of the job ahead, but also the sense that, it's perceived that the executives at UBS are doing a pretty good job of this integration, albeit, as they themselves have said, this year is the really tough year for this mammoth project of getting Credit Suisse completely absorbed into UBS.
So you compared it to the U.S. banks as well, but talk to us a little about how it compares to European banks, given that the bonus pool is down about 14%.
Yeah, so, the bonus pool for all the traders and the deal makers is down. There's been a bit of a mixed bag in Europe. So you've had some banks like a UniCredit actually boost their bonus pools, but largely for sort of the really big players like a UBS and obviously in the UK at Barclays, we have seen that pool drop. 14% is, around about in line with those kind of lenders, and just again speaks to that push by UBS to keep their costs down, and the sense that, Credit Suisse had a much more sizable investment bank, at least relative to its kind of entity size, and UBS is looking to shrink that a bit.
Tom, this coming from an annual report, I think, where typically you find more in the financial statements usually, don't you, about these businesses? But you've managed to glean quite a lot from this statement today. What else stood out to you?
Yeah, there was a really interesting line that you can kind of read the tea leaves on, but a lot of speculation about how long Amotti is going to stay. And previously there was a sense he'd obviously stay through right till integration is complete, which they're aiming for by the end of 2026. But there was a line there, I think, from the chairman saying we expect Amotti to stay at least through then. So when you're reading those things carefully, that kind of wording, a bit like with central bankers, you could read that as suggesting that Amotti's going to be there for longer than perhaps people were initially banking on.
Tom, thanks so much. Tom Metcalf bringing us the latest on the banking sector. Obviously, focused there on the pay at the top and the bonus pool and how that compares to the European competition.
And I think when we talk about the banking sector as well, we have to put this in the context of something, the European interest rate story. Over and over again, we heard it from Commerzbank, we heard it from others as well, that if you're trying to talk about peak rates in Europe that have been kind of fueling these gains in the banks and fueling, therefore, bonuses and these kind of salaries, what does that then mean for the interest rate picture and therefore the banks broadly?
Okay, let's pivot firmly away from the interest rate picture. I can think of no linking thought.
Markets on a high?
Excellent. Thank you, Tom. He should be doing this bit. Europe's largest medical cannabis market, Germany, is set to partially legalise weed for personal use from next week. Bloomberg's Oliver Crook is at a medical marijuana growing and processing facility just outside Dresden. He's dressed for the occasion. He brings us a conversation on this front. Ollie, good morning.
That's right, Anna, away from interest rates, but rates of interest may be high in this story because we are one of the biggest growers here in Germany, where there are only 3 companies that can legally grow cannabis here in Germany, and only one of them is a local German company, and that's Demecan, and that's where we're standing right now, in their grow facility. And this comes as the law has been passed now that starting on the 1st of April, there's going to be a partial legalization, a decriminalization, and huge implications not only for the medical part of this business, but the potential future commercial sales. So I'm very pleased to be joined right now by one of the managing directors, Philip Goebel, who is here. Can you take us first what's going on in this room and a little bit about what the operation is here?
This is one of our growing rooms where we currently grow up to 1 ton per year, which we only can deliver up to now to the German government. As of Monday, we will be allowed to use the 1 ton of spare capacity we already have for grow, which we can then sell directly to the pharmacies. So we already can double our production here at this site. And we also have lots of expansion capacity when it comes to the point which you mentioned, the second column of the law, when cannabis will be allowed for recreational purpose as well within the test regions which are going to be defined.
That's right. So this pilot program we're expecting maybe at the end of the year, the beginning of next year, and that will be selling directly to the public, which is really the game changer here, because you are primarily and really only a medical producer right now. But really, there's a chance in the next couple of years that becomes the smaller part of your business. What do you expect for the timeline for the commercial sale? And illustrate a bit for us the scale of what we're talking about here.
So the cannabis market in Germany is estimated to be between 420 and 770 tons. If you talk to paper producers, which are often used to consume cannabis, they rather expect 1,000 tons to be consumed in Germany.
So this is interesting. I just want to make this point because it's very difficult to get data because this is obviously illegal. So you need to go to the manufacturers of rolling papers to get an idea of how much is being used in Germany.
And the paper from the government for the 400 to 770 tons was taking assumptions from the US, from Colorado, from Canada to estimate the German market size. So we see it's a huge potential market, knowing that the medical cannabis market is just right now about 12 to 13 tons. Still, however, the medical cannabis market over the next 12 to 24 months is expected to grow by 5 to 10 times. So you can see already the big potential within the medical market as a first step. And then when the recreational market steps in, this is obviously a huge growth opportunity as well, especially because within that second part which is going to come, everything which is going to be sold for recreational purposes has to be grown in Germany. And as you said, we are just one of the 3 licensed producers right now who can grow cannabis in Germany.
So that positions you pretty well in the market here. Here's the question. Do you need to actually expand now to fill that capacity?
Currently, we can serve 2 tons out of this facility for the medical market. And when it comes to that second part, we already have the expansion capacity foreseen. We have all the permits in place to quickly ramp up the business to serve that recreational part as well.
Right, which is no small feat in Germany, as we've learned, and across a lot of different industries. And there's been a lot of hype, at least in the United States and Canada, with a lot of valuations for cannabis companies, much less here in Europe. So for you, what are you looking at in terms of speaking to investors? I assume you've got a lot of calls in the last few weeks.
Totally true. So we are currently starting such a Series C with the CLA. So everyone who's interested, reach out to us. So we are doing the CLA now and then close our Series C over the time of this year to keep up ramping up the business in Germany, where we see this huge growth potential, which is besides the growing part, which we already do here. We have service lines where we serve other customers with pharmaceutical services to get their medicinal products to the market, as well as software solutions which we developed for the pharmacies. So we really cover the full supply chain where we see the leverage of this market for the future.
Right, developing really the cannabis ecosystem for the first time in Europe.
It's an ecosystem.
But the Canadians are also at the door. They're growing here in Germany. How do you stay ahead of competition? Because a lot of the sort of overhead and a lot of the barriers to entry aren't that high from a physical standpoint.
From a physical standpoint, that's right, but regulatory-wise, the hurdles are quite high because we are a pharmaceutical production company, so we adhere to the same standards as the big pharmaceutical companies in the market, and that is a hurdle you first need to take. What we got to say as well is that of all the cannabis which is currently grown in Germany, we have 70% of market share, although we only got the smaller number of lots which we can produce, so we got 3, and the other ones got each 5. So we see, as a German underdog to say so, we achieved to high quality standards and have more than 70% market share of that what is grown in Germany.
And I'm curious to get also a little bit of an idea of your relationship with the government and how the government is trying to sort of treat this industry, and how is it trying to encourage it, or has it been difficult?
The government is really supportive to us, so we have 2 states in Germany who invested into the company as well. We got subsidiaries here from the local state of Saxonia, 30%, which subsidized the assets here when we built up this facility, because we have done 70 people who are now working here at our company. We have implemented that. So we see good support also from the local and national governments. We're working very closely together with the BfArM, which is the FDA in the US, where we have a good relationship to build up this business.
Philip Goodwell, thank you so much, and for taking the time and for bearing this sort of tropical climate that we have in here in Demicon. So again, you know, this is a huge opportunity for these guys in the medical industry, but really for any of the investors and for the businesses that are looking into the future in Germany and in Europe. It's tapping into that recreational market, which, as we were saying, you know, they're producing 2 tons here. We're talking about, just for Germany, 450 to 750 tons. And across Europe, the estimates are, if legalization were to proceed more broadly, it could be a $250 billion market.
Bloomberg's Oliver Crook there walking us through some of the numbers. It's a really interesting story because you've seen it actually become a real growth story in other parts of the world. Canada, for example, of course, getting a lot of gains. I think in the state of New York, seeing that as well. In terms of watching some of the growth, let's talk about what else we're going to be watching in terms of today's data docket. At 12:30 UK time, we'll get U.S. fourth quarter GDP. That third reading is going to be coming out. The initial jobless claims as well at about the same time. 2 p.m. UK time, UMich consumer sentiment data, that March final reading hitting at about 2 p.m. there. At 5:30 p.m. UK time, the focus shifts to Europe. The ECB's Villeroy speaking in Paris. And at about 6 p.m. UK time, U.S. Treasury market closing early for that Easter break. And of course, later today, Sam Bankman-Fried set to be sentenced for stealing billions of dollars from customers, marking the final chapter in the FTX case, which shook the crypto industry by storm. We're going to be live at the New York Federal District Courthouse, and you can catch our special coverage of Bloomberg Crypto from 4 p.m. London time onwards. You know, it's interesting, when this story first broke and we saw the ramifications, there was an expectation that suddenly interest in the actual crypto story,
institutional adoption, would be affected.
Right, and we've seen the exact opposite, haven't we?
In the same quarter as we are getting this sentencing, we also saw a record price on Bitcoin.
Yeah, CZ, of course, from Binance, also pleading guilty in a case with investigators, or at least the DOJ in the US, taking a bit of a knock to Binance, one of the other big exchanges, of course.
Yeah.
But as you say, it has done nothing to quell the interest now that those approvals came through January the 11th from the SEC for the likes of BlackRock, Fidelity, and those ETF products.
The ETF story, of course, the driver, and worth mentioning. So as we bring this program to a close, I suppose for markets, there's the data that you mentioned, Critty, on the day book, but tomorrow is the key data point when possibly nobody will be looking.
Yeah, that
and
piece...
no markets will be trading, at least not on both sides of the Atlantic.
Yeah, well, I think it may be a good thing this one time around, given your point earlier in the show, which is that people have been shrugging off this data over again, the CPI numbers, the PPI numbers, the PCE deflator, and of course, Chairman Powell's comments, given we've heard so many of his peers speak this week, starting with Raphael Bostic, most recently the Fed's Waller.
Yeah, so maybe post-Waller, it is a good thing that we have a little time to digest exactly what this PCE data tells us, and of course we'll get that tomorrow when, as I say, markets are broadly closed. That is it for markets today. The European equity story is a slightly positive one, up by 0.2%. Volumes, no doubt, a little depleted because of the market holidays coming tomorrow, and in some cases in parts of Europe next week as well. So US futures flat to negative. The pulse is up next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, you know, Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. Treasuries dropping as the Fed's Christopher Waller says there's no rush to lower rates. We're going to look ahead to tomorrow's U.S. inflation data. Meanwhile, in the stock market, the S&P 500 futures pointing to a higher open on Wall Street after closing at a record high. Meanwhile, here in Europe, Stock 600 also hitting that all-time high on the last major trading day of the quarter. Plus, we are on intervention watch. The yen steadies with many traders eyeing 152 per dollar as a possible trigger for officials to take action. In the meantime, a quick check on these European markets. When you're looking at potentially this last trading day on the screen, you are seeing broadly green on the screen across the continent. And that is interesting given that you would think ahead of a very long weekend, especially on Monday when European traders are not going to be in. American traders will be digesting some of that PCE data, the inflationary comments from Powell as well. How do you position ahead of that? Well, it kind of feels like autopilot seems to be the name of the game this morning. Stock 600 higher by 0.2%. Slight outperformance right here in the UK. In the meantime, I want to get a quick check on futures action across the pond as well, because U.S. futures virtually unchanged at the moment. S&P futures 53.0475 on those contracts. Slight underperformance of the NASDAQ, only down 0.1%. Again, nothing I would write home about too quickly. I would argue all the action is in the cross-asset story. We talked about the equity picture. The bond market, to me, is what matters here because you are starting to see a little bit of a spike in yields across the curve when you look at that 2-year yield and the 10-year yield as well. The 2-year yield higher by, get this, 6 basis points higher to a 463 level. You look at the 10-year as well, 422 I'm seeing this morning, higher by about 3 basis points. Again, that's going to have a big story or a big effect on the currency picture. Dollar yen there, 151.43. That yield picture creating a little bit of dollar strength across many of the G10 currencies. Again, yen intervention watch, if I can make that pun, 152, 153, 155. You have different strategists all saying those are key levels to be watching on the technical front. And of course, Brent crude, given the geopolitical tensions around the world, plus that increase in shipping costs, all higher as well, higher by about 0.5%, trading at an 86 handle. But it all comes down to that inflationary story, and that's where we go next. Federal Reserve Governor Christopher Waller saying the central bank should delay or reduce the number of rate cuts seen this year. Policymakers have penciled in 3 rate cut reductions, but Waller says a strong U.S. economy and robust hiring may have given the Fed a little bit of room to wait. Take a listen.
In my view, it is appropriate to reduce the overall number of rate cuts
or push them further into the future in response to the recent data. I see no rush in taking the step of beginning to ease monetary policy.
So what do you do with comments like that? Let's bring in a true expert. Peter Shaffrick, global macro strategist over at RBC Capital Markets, joins me this morning.
Morning,
the timing, good morning. The timing is so strange here. Traditionally, when you have a holiday like this, you see some of the data prints move. We're not seeing that this time around. What do you make of it? Is this a reason? Are those comments reason enough to change your portfolio today?
Well, I wouldn't necessarily say so, and just because, I mean, you mentioned the bond market is key, and what we've seen is that over the last, I want to say 2 to 3 weeks, we've really sort of settled in a sideways range, maybe in the US about 390 to 430 for the 10-year, and over here in Europe, maybe sort of with a top at 250 and maybe 225 in the 10-year bond. And I think, you know, we're really seeing the split also in the officials' opinions and in markets' opinions, with some people saying, well, there is more inflation in the system and therefore we need to slow things down. And other people are saying, well, no, we're heading back to the target and therefore we can cut. And I think as long as that tension remains, I think the range will remain.
When we talk about that range, though, I mean, there's a big question of whether we get to, I mean, everyone's talking about this range of 3.5 to 4.5, whether we get to even 5 before we get to 3.5. Is that a possibility?
Well, I think it is a possibility, of course. In fact, you know, we have currently, from a tactical point of view, small shorts outstanding in our recommendations because we think there is a risk that if we see some further inflation surprises to the upside, that the market probably breaks to the upside. But then we have very clear communication from all central banks or all major central banks that they will be cutting interest rates. So for me, that's not a question. They will be cutting. It's just then a question, that's probably what Waller was saying as well overnight, is then what comes thereafter? What's the speed? Where are they going to? And I think that's where the market will really settle on.
You say you have a tactical short on bonds at the moment. Talk to us a little bit about why that is. When you're seeing, fair point that the last 2 inflation prints have been slightly hotter, but the general direction of travel is downward. Why the tactical short?
Well, I mean, first of all, as the name suggests, it's a tactical one. So, but nevertheless, I mean, what we're seeing is, if you look at, particularly for this year, but to some degree also for next year, we have the cuts already priced. In fact, we're probably pricing a little bit more than the 3 cuts that, for instance, the Fed is guiding for. We're pricing a little bit more than 3 cuts for the ECB as well. We think they will deliver only 3 this year. So that's already priced. We also know that from a positioning point of view, there's probably quite a few longs outstanding already, exactly for the reason cuts are coming. Therefore, ultimately, you've got to be long in the bond market. And then when you look at sort of the way the market has been trading, we've been kept in that range. But we reckon that if we have 1 or 2 more surprises to the upside of inflation, to the consensus, can still mean that inflation is actually coming down, but probably not as fast as the market is hoping for, then we get a bit of a breakout to the upside.
So the cuts, whenever they do finally manifest, are they a function of growth or slowing growth, or is that a function of normalization of rates? Where do you stand?
Well, it's certainly a combination of all of them, right? Because, I mean, growth is probably going to slow in the US, but it's probably going to pick up a little bit over here. What we do see is inflation is coming back down, but the question is whether it's coming down fast enough to the target. So the central banks, they probably feel comfortable enough that they can lower rates a little bit, and whether they can reduce interest rates much more, that will be in the future, that we will only know in the future. So the first 1, 2, maybe 3 cuts, that's going to be almost a done deal, I think. But what comes thereafter will very much depend on growth and inflation data.
Well, what happens with the dollar in that case? There seems to be a real divergence and dispersion between what the bond market is doing, what the FX market is doing. When is the dollar going to move?
Well, I mean, first of all, most of the FX pairs have been relatively steady. Let's leave the yen aside for a second. But if you look at the European pairs against the dollars, the European pairs against each other, they have been very, very steady. And I think one of the reasons for that is actually that we have a relative weakness over here in Europe. Because when you look at most fair value estimates would probably place, let's say, euro dollar closer to 115, 120, but it isn't. So I think we do see some sort of hidden dollar strength already. And the question in my mind is that if interest rates are coming down, whether that changes. There's very little indication at the moment. So I think what we're seeing is that sideways movement that we're seeing is actually hiding the dollar strength to some degree.
It's interesting because the positioning is really crucial here. So many of people have been kind of short the dollar in a lot of ways, thinking that those rate cuts are going to materialize faster than expected. Just this morning, you're actually seeing, I think, more volatility than I've seen in weeks/months in the European currencies, around a 107 handle on euro dollar. When it comes to that inflation data, though, there's a talk about a 3% inflation story in the long term in the United States, when the target for the Fed is 2%. There's a lot of fun technicals around that. What does that mean? What does long-term 3% mean? Is that even plausible?
Well, everything is possible, of course, and one of the key things, and we're seeing that not only in the US, but we're seeing that over here as well, is that sort of the domestically generated part of inflation, that has remained much firmer or much stickier, I should say. It's not coming down as much as the central banks would like. And I think that's the crucial thing. If that remains the case, and obviously that's intrinsically linked with the strength of the labor market, the wage setting, and so on, with everything that also Waller was talking about overnight. If that remains relatively firm, and therefore we have an inflation sort of baseline that is stronger than what the central banks hope for, that means that they probably can't lower interest rates as much, and there's this debate about where the neutral rate of interest is. It's probably higher than in the past. The inflation component is probably be higher in the past, so the nominal rate can't come down as much, and that's obviously not priced in the market.
You're talking about those sticky parts of the inflation data, though. We're seeing that in housing. We're seeing that in wage data, obviously. How much of that is more of a fiscal story than a monetary one? And the reason I ask that is simply because we're talking about wage negotiations around the world. How much of this is fiscal?
Well, there's probably some element of fiscal, because what we do know in the current environment, budget deficits are relatively wide, and some of the things that the public money is being invested in is probably very inelastic. So what it means is that if the economy is decelerating, it probably still is going to be there because there's a political imperative to fund, let's say, the green transition or energy transition and so on and so on. However, having said that, I think the key is still sort of the labor market. As long as the labor market remains tight, and we can have a big debate about why it's tight, but as long as it's tight, there's an intrinsic upward pressure on wages. And as long as that's the case, I reckon there's going to be strong demand domestically, and that means that there's going to be intrinsically high domestically generated inflationary pressures.
Lots to digest there, and you talk about that in this context of the United States. We haven't even got to the yen piece of that as well. Lucky for us, Peter Shafrick is staying with us. We're not letting him go just yet, the global macro strategist of RBC Capital Markets. Coming up on the program, we're going to dive into that one piece of the equation we haven't hit yet, the story over in Japan. The wage story in the United States, the wage story in Japan, it's a theme we're seeing around the world. We're getting the latest on what's next for the yen. Stick with us. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Our medium-term forecast is actually for the yen to strengthen somewhat. I think over the next year or so, we think it should head back towards 140. primarily driven by the thoughts of the Fed easing further down the road and somewhat tighter Japan policy. So we think that the medium-term picture would be for a slightly stronger yen.
Christopher Wilcox there, Nomura's head of trading and investing, speaking exclusively to Bloomberg Television earlier. I want to get a little bit more on the yen and what that intervention story might actually look like. Bloomberg's executive editor for Asia markets, Paul Dobson, joining me this morning. Paul, long time no see. Pleasure to have you on the program. Talk to us about this tension here. Do things get a little more tense over the weekend?
Good morning, Chrissy. Yeah, we're headed into quite a turbulent period for Japanese markets towards the end of the trading day today, and things have been very calm and kind of locked in quite a tight range. But it could go any which way in the next sort of 3 or 4 days. I'll talk you through some of the stresses that we have there. First of all, the risk that there's a little bit more depreciation, and that's enough to rile the policymakers in the Ministry of Finance enough to intervene and to try to push the yen in the other direction stronger again. 2, we've got a lot of options trades going on either side of where we are right now. Some of them are in the money, but if we were to get all the way to 152 on the weak side for the yen, that might be enough to knock out a lot of barriers, and that would spark further volatility as well. Now, in addition to all of that and the hedging that's involved around that, we're right at the end of the financial year for Japanese companies, and we're heading into this Easter holiday period as well. So markets are going to be thin on Friday. There may be some of those last month-end, quarter-end, financial year-end flows. And then we get the US PCE data right at the end of it all when basically everybody's already gone. Will there be a little bit more price action and volatility around that? If not, we come in again on Monday morning in Asia. Australia and New Zealand are on holiday, and liquidity doesn't tend to be very high at that time of day as well. Japanese markets will be the first responders then. Could see more price movements up and down, more fun and games if you enjoy that kind of thing, or more treacherous conditions if you've got a lot of risk going on out there.
Well, aren't you just a ray of sunshine this morning, Paul, talking to us about the volatility in the yen space? Talk to us a little about the other levels, though. You mentioned 152. I've heard in the markets, technicals are playing more of a factor here. If we don't see that intervention, 153, 155 has been put on my radar. Talk to us about the levels at play here.
That's right. Well, and I think that 152 is really the key because of where those barriers are. But then, what's the red rag for the MOF and for the Japanese officials? What would turn their hand? It's more about the pace of the move for them rather than the outright levels, or at least explicitly that's what they're talking about. They talk about the idea of a 10 yen move or a 4% move, in the space of a short period of time being an unacceptably quick movement. So if we were to see more volatility, particularly if we would get to some of those levels you mentioned in a short space of time, that would be enough to get them motivated. And I think, we're still seeing more of these signs that are giving the dollar that oomph, that strength on the flip side at the moment. We had the comments from the Fed's Waller. That's given the dollar some extra support. That's pushing back the timing of those Fed cuts. And as you were listening to the comments just a while ago, the expectation on the Japan side is that at some point, the Fed starts to cut, and that starts to take some of the pressure off at the yen. But the longer that they have to wait, the more likely it is we get into that sort of a scenario where the finance officials need to take some action, at least to slow the pace of appreciation and buy that little bit more time.
A lot to digest there. Bloomberg executive editor for Asia markets, Paul Dobson, walking us through the potential scenarios around that yen intervention watch. Still with us for a little bit more analysis here, Peter Schaffried, global macro strategist over at RBC Capital Markets. Peter, before the break, we were just talking about this. What does the dollar do next? How much has Christopher Waller kind of given that support, as Paul was just saying? Let's fold in the Japanese yen now, which has really been the base trade for a lot of carry trades. My going theory, push back on this if you will, my going theory is the very, very low FX vol that we've been seeing is largely kind of a complacency attached with this no-brainer carry trade around the Japanese yen. Look at what happened in just the last quarter here. Your best performing G10 trade was going long the dollar against the Japanese yen. How long does that persist? If we start to see this yen intervention, does that carry trade persist?
I'll come back to the yen. I just want to paint a broader picture. I mean, you were just mentioning the carry trade. I think this is a general phenomenon. We see that particularly also in the emerging market space, where we have a lot of carry trades going on in higher yielding currencies, which typically also have been performing a little bit better than the yen. Now, on the yen specifically, I mean, one of the problems that I have with this idea that sooner or later the yen will have to strengthen, that might well be the case, but A, from what level, and secondly, what is the time frame here? Because we have been talking about the same theme for at least the last 6 months, if not longer, and it hasn't worked. And one of the reasons I think why it hasn't worked is, A, because the positioning is already skewed that way, and I thought it was quite informative when we looked at the BOJ move last week. Going into it, the yen actually did strengthen just a little bit, and then when the actual move came, we just went back to 150 and beyond.
Yeah.
So that suggests to me that the pre-positioning lacks follow-through here, and there's probably still way too much positioning going one way that probably needs to be clearer. And then one further point on this, I mean, one of the biggest problems that I see with this is that at the moment, with the way the relative carry works against the yen, particularly for the domestics, is they have very little incentive in actually buying foreign assets and then hedging out the currency, which would mean sort of selling the foreign currency and buying the yen. So they have very little incentive to do that because if they do that, the actual sort of hedged return that they're getting is very low or even negative relative to their own investments. So in my mind, it's not as clear cut as we hear from a lot of places that the yen actually needs to strengthen and needs to strengthen quickly, interventions notwithstanding.
Well, it's interesting because it's coming off the heels of kind of the spooking effect, the start-stop effect that we've seen on a lot of these hedges that have been expecting, say, the JGB shorts to pay off. And it's taken ages for that to do so. Peter Shafrick, Global Macro Strategist over at RBC Capital Markets, we thank you so much for walking us through that story. Coming up, we make a hard pivot. I have really no smooth way to do this. Germany set to partially legalize cannabis for personal use in the coming days. We're going to discuss the opportunities for the commercial market next. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Germany is Europe's largest medical cannabis market. The country is set to take things one step further, with cannabis set to become legal for personal use as soon as next week. Bloomberg's Oliver Crook at a medical marijuana growing and processing facility right outside of Dresden, joining us this morning. Ollie, walk us through what this law actually does.
Yeah, Crazy. So for the sort of medical producers here in Germany, this is also crucial, to say nothing of the sort of personal use. So we're at Demacan here. This is one of 3 companies. It is legally allowed to grow marijuana within Germany, and it is in fact the only German company to do so. And at this facility, they can produce literally tons of marijuana, 2 tons of them. But until now, they've been restricted to only bring 1 to the medical market because of the laws in Germany. What will also change on Monday is that people will be able to possess 25 grams on their person, 50 grams at home. They'll be able to grow 2 plants at home. Starting on July the 1st, there will begin these so-called cannabis clubs where you can communally grow, and that will be of 500 members. They can grow their own sort of cannabis there. But then the real prize for all of these companies and for many investors looking at this is the eventual commercial sale. And they're going to do pilot programs maybe in the back end of the year, beginning of next year, where they're going to start selling directly to the public. And when we think about the scale there, for a company like Demacan, they're already producing about 70% of the marijuana being produced in Germany. And in order to sell for the recreational market, it needs to be grown in Germany. So this is a company that is clearly positioned for that.
Ollie, 30 seconds. How big could the European market actually get?
So, Creedy, this is an interesting question because obviously since it's illegal, it's hard to get a gauge. We're talking about producing 1 or 2 tons here. The estimates are from 450 to 750 tons every year consumed illegally. What is interesting is they have gone to the paper producers, the people who produce and manufacture rolling papers, to get an idea of how many are being used. And from that data, it could be 1,000. So we're talking about potentially legalization across Europe worth maybe $250 billion.
A massive market that you could actually see add to that growth engine. We've seen this around the world. We've seen it in definitely just several states in the United States and Canada as well. Bloomberg's Oliver Crook, we thank you so much. Of course, we're going to be watching that very, very closely going into next week. But let's take a look at what else we're watching for today. At about 12:30 UK time, we get that 4th quarter GDP out of the States, that 3rd reading alongside the initial jobless claims. At about 2 p.m. UK time, UMISH consumer sentiment data, the final reading for March. Meanwhile, 5:30 p.m. UK time, the focus shifting right back here to Europe. The ECB's Villeroy speaking in Paris. And at 6 p.m. UK time is when the U.S. Treasury market closing for the early Easter break. We've got plenty more ahead. Stick with us. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Treasuries drop as the Fed's Christopher Waller says there's no rush to lower rates. We're going to look ahead to tomorrow's U.S. inflation data. Meanwhile, in the stock market, the S&P 500 futures pointing to a higher open on Wall Street after closing at a record. Meanwhile, here in Europe, stock 600 hitting an all-time high on the last major trading day of the quarter. Plus, we are on intervention watch. The yen steadies with many traders now eyeing 152 per dollar as a possible trigger for officials to take action. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lockwood. There's a lot to digest in the currency space. We just talked about it there with dollar yen, very much in focus. 152 is the level to watch. This is really, really interesting because it has been the basis of this trade. I'm showing you here a chart, or I should say a terminal function. You can WCRS on the Bloomberg terminal that just shows you a little bit of what that looks like, how some of the currencies have actually outperformed relative to the dollar. You've seen them actually, the dollar strength story, quite significant there. And I think, or dollar strength story is kind of quite significant there, I should say, in terms of relative to, say, the British pound, the euro. You're starting to see that upkeep in terms of the global stock picture. To me, what's most interesting is the worst performing currencies have, of course, been the Japanese yen and the Swiss franc, which, again, bring it right back down to that global basis trade that we've seen, the carry trade that we've seen around the world. Remember, just because the Japanese yen, or I should say the BOJ, has moved out of negative rates does not necessarily mean that it is seeing the same sort of influx of flows that I think a lot of people may have once expected. That's the currency picture. There's a stock element to it as well, because as we talk about what happens with the dollar and whether it moves, there is a barrier of entry for international investors who want to advance into the S&P 500, into the Treasury market. I think this chart really shows why. The outperformance in the United States, the consumer resilience that you are seeing is incredibly significant. You are also seeing it show up in Europe as well, where a lot of these corporate earnings stories are largely based on the U.S. consumer story, the consumer resilience story. It's really, really important to keep an eye on, and that's just the macro space. One example of that consumer resilience, one example of the United States feeding European companies, for example, shows up in Novo Nordisk. A new report saying the blockbuster obesity drug Ozempic could be produced profitably. Forget this, less than $5 a month. Denmark's Novo Nordisk charging almost $1,000 for the treatment in the United States. I'm joined now this morning by Sam Fazeli from Bloomberg Intelligence. Sam, this is a really interesting report that has already got politicians fired up on both sides of the aisle. Talk to us about kind of gross to net about the issue.
Yeah, hi. This drug pricing is emotive. It impacts a lot of people, and politicians love it. So when a paper like this is published, which was published in JAMA Network Open, it's not at all a surprise to me that they jump on it. However, there are many nuances here that have been completely missed, i.e., as an example, the list price that people quote often for an insulin drug, say it's $1, whatever, $50, say, right? Only 10% of that is kept by the manufacturer. These gross to net issues are significant and are often missed in conversations about drug pricing. Ozempic, example, is a 70% discount. So every 30 cents out of $1 is kept. Now, I'm not defending the pricing of drugs in the US. I'm not saying they're right, wrong, but there's a reality as to this drug would not exist if Novo Nordisk had not done the R&D on it and the 10 years of development that's gone on it. That costs money. We wouldn't have known that it helps people with their cardiovascular disease if they hadn't done a 17,500 patient trial over 4 or 5 years, which costs huge amounts of money. So we have to be very careful, and I know that a lot of people know this, to not just take these numbers on face value.
So talk to us about the utility of the study, though. Is there anything that we can kind of use out of it?
The utility, sorry, I didn't hear that. You just went out for a minute. The utility of this particular study?
Yes.
Okay. Well, look, it's not difficult to go and find data that shows that drugs, when you manufacture them, are cheaper. Cornflakes can be made for 25 cents, say, and the box costs $2.50, or you convert that to pounds, for 25 pence and £2.75 on the shelf. There is always a markup as you go through the supply chain, the box and the marketing, etc. So that's not news here. Obviously, these prices that we're talking about are significantly different. But the study is useful in its own right as to telling you how much it costs to get the active ingredient made. Then there's another layer here. Where are these drugs made? On the one hand, politicians in the U.S. want to distance themselves from China and regions which such regions where products are made, and at the same time, they use this kind of study, which I'm pretty sure included manufacturing costs of drugs in developing countries or such countries such as China, as a base for their information. And they want to use that for fighting the pharma companies. So we got to decide, do we want to go and buy cheap products from China? If we do, then you could try and bring drug prices down in the US using those kind of drugs. You can't have your cake and eat it.
Well, it's an interesting kind of dynamic that you mentioned there, the international story. You talked about those R&D costs, which kind of justify the pricing for Novo Nordisk, that very big upfront spend that you see, which is very common, by the way, from pharmaceutical companies and biotech, as you well know. But when could we see that pricing dissipate? Is this a years-long, a decades-long prospect?
Yeah. That's an excellent question, Kriti. And just to be clear here, I'm not justifying a particular price that Novo Nordisk has set, or Eli Lilly has set, or any pharma company has set. All I'm saying is that there are many layers of nuances in here that we have to be careful with. So in terms of drug pricing coming down, already Ozempic is gross to net of 70% discount. And that price is going to continue to fall. How do you end up with insulin at 90%? Through the same market forces. As new drugs come to market, as the volume goes up, there are systems in place that can reduce that price that people have to pay. Unfortunately, the drug pricing is so opaque in the US that nobody knows where the segments are and who's taking what margin where and who's getting an extra commission on a sale of a product or extra margin on sale of a product in the line of folks involved between the manufacturer and the patient. So that's the problem that we have. We need transparency there, not just shouting at pharmaceutical companies.
I mean, that's something that I think both parties, both sides of the aisle are actively addressing. Bernie Sanders, for example, tweeting off of that report about that very issue. Sam Fazeli from Bloomberg Intelligence, we thank you so much for diving into the details around that report and what that actually means for Novo Nordisk. In the meantime, let's get to some of the other stories making news. UBS has cut its bonus pool by 14% after a tougher year for deal makers and traders alike. The Swiss bank has also increased its cost-saving targets amid the integration of Credit Suisse. Now, UBS's annual report revealed that CEO Sergio Ermotti was paid 14.4 million francs for just 9 months on the job. Ermotti being brought back in April last year to oversee the rescue and integration of the bank's former rival. Index provider FTSE Russell saying Portugal will be added to a key government bond index, but held off on a decision when it comes to South Korea and India for at least 6 more months. Portugal joining the FTSE World Government Bond Index from November. South Korea stays on the watch list for inclusion in the FTSE Global Bond Index, while India remains on watch to join the emerging market equivalent. And earnings over at Jefferies rose in its fiscal first quarter on strength in capital markets and renewed activity in the investment banking business. The New York-based firm says revenue jumped 35% on improved debt and equity underwriting as concerns around inflation and interest rates started to stabilize. And we go from banking to Amazon, where investing an additional $2.75 billion in Anthropic, completing a deal it made last year to back the AI startup. As part of the deal, Anthropic will use Amazon's cloud services as its custom computer chips. Anthropic was formed by former OpenAI employees and offers a chatbot named Claude. Now, coming up on the program, we go right back to the banking space. The world's biggest banks quietly hang on to carbon-intensive clients, exposing the cracks in the world of climate finance. That story next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This is The Pulse. I'm Kriti Gupta in London. We're getting breaking headlines here that the ECB is set to approve the first Greek bank payouts since 2008. The last time they did that, again, was right before the country's debt crisis started in 2010, right as well before the global financial crisis really kicked off. The significances of this is enormous, simply because the measure was taken back then because of the risks around not just the banking system in Europe, but the Greek debt story as well. The fact that you are now seeing this allowed again suggests that this is really a testament to the strength that you were seeing not only in the Greek bond market, investment grade, for example, now being given as that title to the Greek debt that was, say, just 10 years ago, seen as very, very risky. Now you are actually seeing that exposure to banks perhaps increase from global investors if they indeed pursue that dividend. The payouts, however, are likely to be less than the banks originally requested. They're really easing into this, but it is suggesting just that sign of normality that we have largely been expecting from a country in the periphery that has largely been outperforming some of its other European peers. So that is the story there. We'll get you more headlines as we get them right here on Bloomberg Television. In the meantime, the Lloyd's of London has recorded its most profitable year for underwriting since 2007. We spoke to John Neal, the chief executive of Lloyd's of London, and what's going right for the business.
We've been working really, really hard to get performance back in shape. So good to be reporting growth, good to show improvement in revenue. We wanted to get costs in order, and we've also wanted to show leadership. So a lot of conversations with us around diversity, equity, and inclusion, and around climate. And I do feel it's really important for UK PLC, because 80% of our revenue comes from outside of the UK. So to represent the credentials of financial services and what insurance can do in the UK is fantastically important. So really, really pleased to be reporting the results that we are today.
Yes, because a lot of people ask questions about the role of the City of London, I suppose, at this point, post-Brexit, and with the listing story not playing in London's favour. You know, a lot of businesses choosing to either leave or to list in the United States and elsewhere. But you feel from the insurance space, London still has a lot to offer.
I think it is the only true marketplace for insurance in the world, and we've reported double-digit growth now for 3 consecutive years. And to give you an idea of where the geography comes from, over 40% of our income actually comes from the United States. In fact, two pounds out of 3 of what we do comes from North America and Latin America. So real geographic spread in what we do, hugely valuable, I think, for UK PLC.
John, does the kind of performance that we've seen then over the last year, does that continue for Lloyd's? And what do you, in terms of reinsurance pricing, they're relatively elevated. How does that story evolve for you?
So it's interesting. So last year was helped by 2 things, really. So the frequency and severity of natural disasters, and we'll talk about Baltimore in a minute, was slightly lower than we'd normally expect. So that was good news. And isn't it exciting to actually be making some money on our assets? So we quite enjoy having interest rates. So for the first time in like 15, 20 years, we're making money on both sides of the P&L. Yeah. So we do think the performance is sustainable. So there's always going to be a bit of cyclicality, but we don't think this is a one-off. You know, it's been a consistent, steady improvement in performance that we think we can maintain.
Not a one-off, and of course the interest rate regime is likely to change this year, so that's going to evolve as well. Let's get to the marine insurance then, and the Baltimore disaster. We know the bridge was insured, the boat's insured as well. There's a lot at play here. How material is this for Lloyd's? Have you been able to put a number on it yet?
So from our point of view, as you would imagine, we go through multiple scenarios of different type of loss. Do we ever get every loss right and consider every loss? No. But the type of loss that we've seen is one that we would envisage. So we would assume every year this type of loss will occur for us somewhere. So within our financial considerations, manageable. And you said in your remarks, which is something that's so important, you know, when I think of natural disasters, what upsets us most as insurers is we have the capacity to insure, and almost every loss you see is only half insured. People aren't buying insurance, so we don't do a good enough job of selling the value of insurance. In this instance, as you've just said, the boat's insured, the bridge is insured, the port authority's insured. So from a financial perspective, the money is there to deal with the loss. I mean, there'll be the issues of what happened and whose fault was it, and all those debates will rage, but the good news is this is insured.
And so to help us understand with your marine insurance expertise, you know, what are the types of claims then that we're talking about? What are the building blocks that we need to look at to add up to the full picture of insurance exposure around this event?
So you've got the easy bit, which you can see that, you know, I mean, these things today play out on our TV screen. Yeah. So you can see the damage to the boat, you can see the damage to the bridge. You know, the cost of the bridge will run clearly into hundreds of millions of dollars, as will the damage to the boat. These boats are 400 metres long and 300 metres high. They are vast in terms of size. So you can see the easy bits. The complicated bits are the supply chain related issues. What impact is this having on the ability for goods to move around the world? What delay and what interruption does it cause? That's the harder bit that takes a little bit of time just to work its way through. Yeah,
just back to the sort of the Lloyd's marketplace and its role in this. I mean, analysts at Barclays say that some of the smaller Lloyd's firms may be the most exposed to the Baltimore Bridge claims. Have you estimated that? Have you got anything you can tell us on that front?
So I don't think that's correct. I mean, interestingly, with the insurance of shipping, there are these clubs called protection indemnity clubs. There are 12 of them. They gather together under the international group. They insure 90% of the world's shipping. And then they buy insurance, if you like, they lay off with us and others, so we reinsure them. So there's quite a complex weave of insurers that are involved with this, but it's the international group that sits at the bottom of the chain, and they will deal with the loss. But no, I agree with Barclays that this has the potential to be one of the largest marine losses in history, but no, I don't think we've got anything that's causing us concerns to think that anyone...
Just on the Barclays point, $3 billion is the number they put on it. Does that sound about right to you?
It could be. I mean, it's a multi-billion-dollar loss. I think it has to be, but I think it's a little too early to say what do you actually think it's going to cost. But, you know, in terms of the earlier question, do we sort of scenario manage and anticipate losses of this size? The answer is yes, we do.
John Neal, the Chief Executive of Lloyd's of London, speaking to us earlier this morning, talking to us about what the insurance costs around the Baltimore Bridge and the wider tensions in the shipping space actually means for the company and for some of the other banks involved as well, which brings us to our Bloomberg's Big Take. The world's biggest banks quietly hanging on to carbon-intensive clients because of what they see as unrealistic demands from regulators and civil society and the threat to their fees. Joining me now for more on this, Bloomberg's Alistair Marsh, all over this story. Now, on the surface, it's not that exciting. If you go into the nitty-gritty, it actually really is in terms of this connection between the banks and this climate transition. They're feeling pressure really on both sides. Talk to us about how far they've actually gotten, what that relationship looks like.
Sure. Well, I'd say it is very exciting.
Oh, I believe it. You made me excited about it. Go ahead.
Well, here's why it's exciting. It's exciting because the energy transition, i.e. the movement of the fossil fuel-based economy that we have today to one that's based on low-carbon energy sources, will be a massive economic transformation that requires trillions and trillions of dollars of investment and financing, which is where the banks come in. Now, all of the major Western banks, North American, European banks, have made net zero commitments. They did that about 3 years ago. They've said essentially that our lending and financing will be aligned with the 1.5 degree target that we sort of globally have set in Paris, at the Paris Climate Accord. But actually, that's easy to say, hard to deliver on, because the reality is the world is way off track from 1.5 degrees, and many of the most profitable clients today are fossil fuel companies. There's been a real resurgence in the last few years of, big oil profits, and those are the kind of clients that you want to keep on your books. But you can't really keep them on your books if you want to commit to if you want to stay true to what you've committed around climate. So there's a real tension here, and this story is about that, basically.
Is that an unrealistic expectation from the get-go, though?
Well, I think a lot of banks were happy to kind of over-project what they could do at the beginning. There was this sort of idea that banks would be the climate saviors, that the private sector would lead here. And actually, it turns out that private sector appetite for leading is diminishing by the day, because of some of the things I was mentioning just now about the resurgence of fossil fuels. So yes, it was perhaps naive and ill-advised to expect that the finance sector would lead this, but as I said at the beginning, the transition comes with a price tag of $5 to $10 trillion every year. Where's that money going to come from? Mostly from the private sector, from banks. So without the banks and without the investment managers, there will be no energy transition. So yeah, it's complicated.
Well, add one more kind of perspective into the story. You cited a UBS banker. What did he say?
Sure. So in the story, we cite this banker, Judson Berkey, who's essentially UBS's head of sustainable finance regulation. And he kind of let loose on regulators at a meeting in Tokyo. And he said, it's unrealistic that you request that we banks align our lending, our financing, our investing with a 1.5 degree world, because we don't live in a 1.5 degree world. We live in a world that's on course for 2.8 or maybe 3 degrees of warming, which, by the way, is catastrophic. And so how can you possibly expect us to align with that? The only way that you align with 1.5 is you divest today of most of your carbon-intensive clients. And that's clearly something that banks don't want to do, because those clients are very profitable and they have long-term relationships with them, and that doesn't get us anywhere towards net zero. So there's this real tension at the heart of banking today.
Yeah, certainly something we're going to be keeping a very close eye on. Bloomberg's Alistair Marsh walking us through that crucial story, the tension in the banking space and the climate finance space as well. Coming up, we take a different approach to Wall Street, this time in the IPO market. Reddit suffering its biggest drop in a day as one researcher casts doubts on the share price. Those details next. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Reddit shares notched their largest one-day drop since the social media company's trading debut last week. As well as Hedgeye Risk Management released a report adding it as a short idea and saying it should fall, get this, 50%. Bloomberg's Charlie Wells holding on to the edge of his seat here. What's the rationale behind the short report?
I mean, look, they're kind of asking some of the key questions that people have been saying about the markets lately, and it's, how far can this bull market go? And then also, Reddit pitched itself as an AI company, or at least a sort of AI-adjacent company, and I think the big question here is, how bright is that AI halo? How long is that light going to last? Hedgeye is basically saying that they see a positive earnings report coming in May, but they're concerned about what happens in the second half of this year and the first half of next year. They think this stock should be valued at about $35 a share, close to that IPO price.
That is a scary level, and of course we'll see that because it's kind of been this beacon for risk-taking that we've seen in the broader IPO market. And speaking of risk-taking, we got to talk about crypto here. It's a big day for FTX, for Sam Bankman-Fried, a U.S. district judge scheduled to have that sentencing. Prosecutors arguing that the former CEO of FTX, should get the 50 years in prison. 50 seems to be the magic number. How is today likely to play out?
Well, look, I mean, this is going to be sort of a bellwether moment for crypto crime. I mean, it's really interesting. We're in that bull market for crypto right now. It's almost easy to forget that crypto winter and all of these, allegations and as well as convictions that came out of the previous bull market. And look, there's a wide gap between what prosecutors want and what SBF's lawyers want. So there's that 40 to 50 on the prosecution side. His lawyers have been asking for 6.5 years. And so this could be a bellwether depending on where the judge falls.
Bloomberg's Charlie Wells, lots on his docket. We thank you so much for bringing that. And later today, as he said, we'll be watching that very closely. We'll be live at the Federal District Courthouse for that case. Live coverage starts at 4 p.m. London time. Stick with us. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture,
covering the intersections of Hollywood, Silicon Valley.
The Fed is telling us it wants to start the easing process in the middle of the year, and it's willing to do so even if in the first half of this year it's getting uncomfortably high inflation.
They want to cut. They still firmly believe that policy is restrictive.
It is clear that the Fed is on the path towards lowering rates in 2024.
The big risk that I'm concerned about, a sustained reacceleration in inflation that the Fed cannot deliver at some point in 2024 on rate cuts.
They need to be open to the possibility that inflation is sticky, and I think that changes their communication and the rate path.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market pulling back just a touch on the S&P 500, negative by 0.1%. Wrapping up Q1, another decent month of gains on Q1. Year to date, up by 10% on the S&P 500. God bless Governor Waller. At least you get some consistency. In a previous speech, the title of the speech, What's the Rush? The latest speech, There is Still No Rush. Sometimes they can just make it very easy for us. You don't even need to read the speech after you see the title.
Which is the reason why maybe people aren't reacting more than you would expect, given the fact that he had very hawkish words to say. Basically, stop expecting all these rate cuts because I don't like what I saw. And if we see this type of inflation data continue, perhaps we have to push back how many rate cuts and when we start.
I love the balance of risk question on the FOMC. I think it's something you have to ask every single official. What is the biggest risk? Holding too long, cutting too soon? I think it was pretty obvious about it. He said the strength of the US economy and resilience of the labour market mean the risk of waiting a little longer, Lisa, to ease policy is small and significantly lower than acting too soon. The question I've got, does that argument win out everybody else on the FOMC?
And right now, if you take a look at the market, the answer is maybe. I mean, it seems like people aren't necessarily buying wholesale into Chris Waller being the mainstay of Fed governors and how they feel, Fed officials. When you take a look at the odds of a March rate cut, you're looking now at 55% versus 63% yesterday before the comments. Not a significant change. At this point, Chris Waller is a known hawk. There's still no rush for him. Is there a rush for some of the others who we'll be hearing from tomorrow in particular?
There is a rush to upgrade targets on the S&P 500, that's for sure, over the last couple of weeks. We get another one overnight, this time from RBC, AMH, Lori Calvasina, lifting the year-end price target to 5,300 from 5,150. We've seen this from a series of banks over the last few months.
Yep, she's talking about spring cleaning when she wants to lift her S&P 500 forecast. That's in her 2024 view. She's lifting that price target. But Jonathan, JP Morgan yesterday, they're noting, their chief global equity strategist warning banks' clients that, quote, don't be stuck on the wrong side. In case there is a pullback, you do not want to be stuck on the wrong side, yet people continue to lift upgrades for 2024.
You know, I kind of love this. Let's just talk about, she went through her forecast. She said we lifted it from 5,000 in November. It was 5,150. Now we're moving it to 5,300. You know, it's kind of like we have to kind of do this because it's already moved so far beyond where we are, which kind of shows you what a surprise this year has been on so many levels in terms of just the strength and the continuation. It's hard to find someone bearish, and when you find someone bearish, they're apologetic and very, very self-conscious.
The rally has changed. I think we should frame the last 5 months or so and split it up 3 and 2. So 5 months of gains on the S&P 500, a move of something like 25% since the end of October. The first 3 months saw the 2-year yield drop by something like 80 basis points. Okay? The last 3 months, the 2-year yield has risen by close to 40 basis points. So the first bit of the rally was all about pricing in rate cuts from the Federal Reserve. Then the second half of the rally was all about pricing out rate cuts from the Federal Reserve because the data was better. This has been 2 very different stories, even though it's been quite consistent in terms of the gains.
And if you look at under the hood, it is broadening out. I was taking a look at the different dissection. You could see that the S&P is up by 10%. The NASDAQ is up by a little bit less than that. And you could see a divergence within the Magnificent Seven. The Nikkei is the big outperformer, up 20% so far in the quarter. It's as if this isn't necessarily the same monolith that it was 3 months ago. It is a new type of bull market that people are expecting can broaden without sort of the insecurity that Chris Waller's raising, which is what if this is sticky? And what if we cannot cut it all? Because frankly, you're making it really tough.
Public service announcement, just to throw one in there for you. If you are based here in New York City, you're in the market, excited for a 3-day weekend, don't get too excited. Later on this evening, there might be a lot of traffic. We're going to get 3 presidents in the same place in Midtown Manhattan. We're going to see Obama, right, Clinton, and Biden trying to raise something like $25 million US.
Yeah, that's right. President Biden out front when it comes to fundraising. He is literally crushing the former president when it comes to the dollar signs in his war chest. And he's going to be adding to that this evening because they're calling it really a star-studded event because he's going to be joined by Barack Obama and Bill Clinton to try to bring in more of those campaign donations. And Jonathan, you talk about traffic. The former president is also going to be in New York today. So there's going to be a split screen of what's going on between these dueling candidates.
These are the kind of things that get Lisa very excited.
I'm leaving town.
Are you? You're getting out of town tonight?
100%. I actually am. That sounds absolutely dreadful.
I don't think you're the only one. Equity futures right now on the S&P 500 pulling back by 0.1%. No big losses on the screen this morning. Some big gains over the last 5 months we'll get our teeth into in just a moment. In the bond market, yields creeping higher again by 3 basis points. On the 10-year, 4.22. And in foreign exchange, just slowly, this dollar strength story starting to build. The euro, 107.76, dollar stronger. Dollar yen, the line in the sand for so many. Bramo, 152. Yesterday, 151.97. This morning, 151.44.
Is 152 actually the line in the sand, or is it sort of the way that it gets there and whether they can just sort of allow it to drift to 152.50? I mean, these are the levels that people are talking about at a time where people just didn't buy the intervention, the verbal intervention that they had yesterday. So really, this is a show me the money kind of story. Does the Bank of Japan step up, or are they going to leave this to jawboning that seems pretty ineffective?
It's just a tiny bit of yen weakness on the screen so far this morning. Here's the next hour for you. Over the next 60 minutes, we'll catch up with Larry Adam of Raymond James as the S&P 500 hits another record high before closing out Q1. Eric Nelson of Wells Fargo as we look for intervention from the BOJ. And Constant Hunter of Macro Policy Perspectives as Fed Governor Waller pushes back on rate cuts. We begin with our top story. The S&P 500 hitting yet another record high as investors look to round out the quarter. Larry Adam of Raymond James saying the rally has room to run. We believe the equity momentum is likely to continue because we are in the early stages of this bull market. Larry, I'm pleased to say, joins us now. Larry, we talked about this last time you were on. I think we have to repeat the conversation because you're repeating the effort. Why do you think we're in the early stages of a bull market when some people keep saying we're late cycle, this is going to end, and it's going to end soon?
Well, I just look at what's been happening to this economy, and I do think that we're going to be able to avert a recession. So we'll continue to see earnings continue to move higher. If you look at the sheer magnitude of what's happened with this bull market, it's one of the weakest bull markets that we've ever had if you go back, in more recent times. And then if you look at the average duration, usually bull markets tend to last about 5.5 years. We're only about 1.5 years into this bull market. So I still think we have plenty of room to run, although I would say that I am a little bit more cautious here in the near term.
Larry, let's dissect the last 5 months together. We mentioned briefly about the relationship or lack thereof between the bond market. I just want to talk about valuations before we get into that. November, I was going back over my old notes yesterday evening. November, we were talking about being priced for perfection. 2 months later, January, we had a bunch of notes saying we were priced for perfection. And Larry, we still get guests coming on the program today at the end of March saying we're priced for perfection. We were priced for perfection 25 percentage points ago, and we're still higher. Larry, can you tell me exactly what we're priced for?
Well, I think we're priced for perfection, but that's because earnings have continued to move higher. I mean, when you came out of last quarter's earnings, you've seen a pretty significant upward revision to earnings, and that's why I think it's allowed the markets to continue to move higher. But I agree with you that earnings right now, where we are, price valuations, we are pretty expensive. We're in the top decile when it comes to PE valuations for over the last 20 years. If you take out the COVID time period, it's probably the most expensive we've been over that 20-year period. So that's one of the reasons why I'm a little bit more cautious as we sit here today.
Forgive me for being a bit confused. It's the beginning of the bull market, but you're also cautious and kind of trying to sit on your hands. Which is it?
So shorter term, again, I think you guys mentioned at the beginning of this section, you know, the market's been up 27% over since the lows of October, right? Usually you tend to see that type of performance coming out of a recession, not going into a soft patch. But that being said, usually you have 3 to 4 pullbacks in a given year. We haven't had one in 6 months. So we're already about double the time period that you usually get a pullback. Once we get that pullback, which I think you're going to see the equity markets pull back to around the 4,800 to 5,000 level, that'll continue to set up a pretty nice run into the end of the year. But when I look at the fundamentals, I don't see earnings moving lower anytime soon. When I look at this economy, as long as that remains strong, that'll continue to propel those earnings. And I'm really not as concerned about the Fed cutting rates. I don't care if it's 1, 2, 3, 4, 5 times. I think it's more important, what's the impact on the economy? And as long as the economy remains strong, those earnings will be there.
Are you saying that if the Fed doesn't cut rates and keeps rates where they are between 5.25% and 5.5% for the remainder of this year, the market could still hang in there and remain incredibly attractive just simply because there's enough economic strength that is not necessarily a restrictive rate?
So I think if the economy were to continue to do better than what people think, that is a potential scenario. Our scenario, though, is that the Fed does start to cut starting in June. It will take some insurance cuts to make sure it increases the likelihood that this is a soft landing. Because I do think you're going to see a soft patch coming during the middle 2 quarters, second and third quarter, but it won't be enough to take us into a recession. It'll just be a mild slowdown to set up for an acceleration of growth towards the end of this year into next year.
Let's pair that with sector preferences, Larry. What we've seen through March is outperformance on energy, outperformance on banks, relative to information technology on the S&P 500. Tech hasn't been dominant in the month of March. Larry, would you extrapolate that out given the recovery you're expecting in the second half of this year?
No, I mean, we still like technology. I think once we get back into earnings season once again, you'll probably see those companies deliver on the earnings side. You know, if you go back over the last 10 years on average, those companies tend to outperform their earnings expectations by an average of 7%. And I think you're going to continue to see those revisions moving higher. So we do like technology. I do like healthcare, and I do like the industrial sector, because one of the things that we do believe has happened here is that we're in the bottoming process of those manufacturing indices that have been coming out. And historically, once you hit a bottom, industrials tend to outperform pretty dramatically over the next 12-month time period.
I think a lot of people would agree with you, Larry, and talk about how expensive the stock market is right now and valuations making them a bit queasy. Question is, what do you do with that? Do you hold more cash and wait for a drawdown of some sort to come step in? Do you just basically hang in there and say, long term it's good, short term maybe we can reallocate? How do you handle sort of near-term pessimism and long-term optimism?
So I think you keep your holdings that you currently have in the equity market. You know, we've had people that have excess cash on the sidelines. You know, with a 5% plus rate in money markets, there's been no rush to really put that money to work. But if we get a pullback to the area that we're looking for, closer to that 5,000 level, I think that sets up a reasonable opportunity, particularly for somebody that has a long-term horizon for this equity market.
The elusive
That's what I
dip
would start to employ.
that everyone wants
Sorry?
to buy. It's the elusive dip everyone wants to buy, Larry. Larry Adam of Raymond James. Larry, thank you, sir. The elusive dip, Ramo, because we haven't really had one for 5 months.
Exactly, which is the reason why I kind of wonder how people handle this type of thought, because truth be told, a lot of people have it. Valuations make them feel a little sick, but at the same time, it's sort of hard to not buy if you see not a lot of gray clouds. If you're not worried about the Fed, and if you're not worried about weakness, and if you're not worried about, the boogeyman coming out of the corner, what's going to really cause that drawdown?
Everything people were saying about valuations, same story, 800 S&P 500 points ago. We kept repeating the same line the whole way up.
Which is the reason why momentum is a hard trade to bet against, and that's what we keep hearing from so many people, which is why I can get over its skis. Maybe we're just not there yet.
Matt Miskin, later on in the program, is going to weigh in on that exact point. Equity futures on the S&P 500, negative, little softer, but no real drama here. We're off the lows. We're down by 0.06% on the S&P. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Former crypto mogul Sam Bankman-Fried will be sentenced today over his role in the 2022 collapse of trading platform FTX. Bankman-Fried was convicted back in November of fraud and conspiracy, with a jury finding that he illegally used money from depositors to cover personal expenses, including the purchase of luxury property. Prosecutors recommending a prison sentence of 40 to 50 years for Bankman-Fried. His family and friends urging leniency, saying FTX investors have largely recovered their funds. While UBS cut its bonus pool last year by 14% after a tough year for traders and deal makers, its CEO now ranks as the best paid European bank boss. Sergio Aramati received $15.9 million in compensation for his first 9 months in the role. He was brought back as CEO in April last year to oversee the bank's rescue of Credit Suisse. UBS reported a record annual profit of $27.8 billion, largely driven by windfalls from the takeover. Major League Baseball's owners unanimously voted to approve David Rubenstein as the new controlling owner of the Baltimore Orioles. The franchise has been valued at $1.7 billion, with the co-founder of the Carlyle Group taking a 40% stake with the option to buy the rest of the team when longtime owner Peter Angelos died. Angelos passed on Saturday, but Rubenstein has not yet spoken to the family about purchasing the rest of the team out of respect. That's your Bloomberg Brief. John?
Very, very cool. Yahira, thank you. I understand it's opening day tonight, right? So they've done that just on time.
Yes, and a number of teams are actually doing their opening day over in Korea, which is sort of interesting. It sort of highlights the increasing Asian...
I've seen that with the NFL in the UK as
big
well.
Time, which is the reason why people think that the Los Angeles teams have an advantage with getting good players because they have a good time zone for...
Do we support the Orioles now? Is that a team thing?
I don't
so
know.
Like Yankees over here, Mets over there.
Yeah, I guess it's up to you.
We're going to do the game. Yes, we are.
Yeah, Subway Series.
Mets Yankees a little bit later on this year.
Maybe.
We'll make that happen. Up next on this program, traders eyeing possible intervention from the BOJ.
I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder.
That conversation coming up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Closing out the quarter, closing out the month, equities just a little bit softer on the session, up big time over the last month and quarter, though. Over the last 5 months, up by something like 25%. Equities negative by 0.06% on the S&P. Yields up by 3 basis points, 421.80 on a US 10-year. Under surveillance this morning, traders eyeing possible intervention from the BOJ.
They laid the groundwork in terms of how to think about their policy when they dovishly hiked to zero. The rate differentials around the world still remain fairly robust. I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder that, since they've taken out kind of that big gap from the perspective of if they actually aggressively approach policy, which they didn't.
Here's the latest this morning. The yen steadying after reaching its weakest level in about 34 years. Traders now eyeing 152, a level that many expect would prompt intervention. Eric Nelson of Wells Fargo saying this: the more sustained turn in dollar yen relies on the US side, particularly now the BOJ hike has come and gone. Eric Nelson joins us now for more. So Eric, are you saying that words are insufficient, words are not enough?
That's exactly right, John. Just because we have this intervention threat hanging over, and we are seeing maybe some shift in leadership on the funding side, funding currency side, with Swiss franc maybe coming to the forefront, it doesn't mean you should buy the yen. We really need to see a very clear turn in the U.S. and/or the global data, and a turn toward the market pricing in significantly more rate cuts. And right now, if anything, the market's moving the opposite direction with regards to the Fed.
So, Eric, when you take a look at the implications of this, are you basically saying that they don't have the guts to come in and actually do real intervention at 152, and that they would accept 152 or even 153 as long as it's controlled?
Well, Lisa, I think 2 points to make would be, first, it's not just about levels, it's also about volatility, right? You look at realized volatility, basically how much the currency has moved intraday over the past few weeks. Dollar yen has been pretty subdued in terms of its daily moves. Now, if we break through 152 and we suddenly get to 155, say, in a couple of days, I suspect they will actually intervene. They will put their money where their mouth is. But if we move very gradually, they don't necessarily have to do that. And I think that's a really important distinction. It's not just about what level we get to.
So what's the thinking here in terms of why it's okay to have this kind of weakness? They don't care about the kind of import inflation that people previously were talking about?
I wouldn't say that they don't necessarily care. I'd say that the domestic price pressures are still very well behaved. We've obviously had a lot of strong wage numbers from the annual wage results. But if you look in aggregate, wage growth in Japan's running around 1.5%, 2%. It's not running away from the BOJ. They're okay to tolerate a little bit of yen weakness here in the short term, particularly if they can avoid the opposite problem. Right? What they're really worried about is the yen strengthening too much on the back of this, normalization. I think they're very happy with the recent yen price action, given the magnitude of the change they made. So for right now, they're happy to tolerate, again, very modest, gradual weakness as long as it doesn't run away from them.
Well, if they do intervene, like you say they could at some point, what's the base case of what that intervention actually looks like?
Well, see, this is an important, really important detail here, Anne-Marie. I think in terms of the actual sort of movement in dollar yen we could get, you look back at 2022, we obviously had 2 big periods of BOJ, MOF intervention. We were looking at 4 to 5, and sometimes even larger moves, 4 to 5 big figure moves in dollar yen. So if we kind of get up to 154, 55, let's say, on the intervene, you could easily break back below 150. The question we get all the time is also the mechanism. Are they actually selling U.S. Treasuries? We've done some work on this that shows they don't necessarily sell Treasuries in advance of intervention, but oftentimes they're using cash on hand, selling treasuries after the fact, and using that the proceeds to sort of replenish their cash holdings. It's a bit of a nuanced distinction, but important in terms of how it affects the U.S. And, frankly, global bond market.
Interesting. So, Eric, let's talk about the U.S. side. You talked about the dollar side of the trade and the importance of it. So many people on the program at the moment bullish on the U.S. The word we hear a lot of, exceptionalism. I want to understand from your perspective whether there is greater scope for positive surprises, given that it appears to be, at least relatively speaking, a high bar in the U.S.
Yeah, this is an important distinction, John. I hear a lot of people, a lot of clients talk to who tell me the U.S. economy is booming. I don't think that's necessarily true. I think it's done better than anyone would have expected, given the level of real rates, certainly the Fed included. The problem here is that it's just not slowing as much as the Fed or others had expected, and that's what's really hard for the bond market to digest right now. So if we look ahead to next Friday's jobs report, if we get another pretty solid report, even you don't have to have a 300K number on jobs. Let's say you get 210K. The market is going to have a really hard time, rallying significantly on that number. I'm talking about the bond market here. And so that's going to be challenged for dollar yen. Coming back to the dollar picture, no one wants to get really short the dollar right now. We're probably late in the global cycle. There are some risks on the horizon. And so we're recommending in the G10 space against the yen and other foreign currencies in G10 space, being long dollars over the next 3 to 6 months for that reason.
Including against the euro, Eric?
Yes, yeah, and if you look at kind of historically, this realized, this very low volatility regime that we're kind of stuck in right now tends to be a good leading indicator for 3 to 6 months out, broad dollar strength. So I think the euro is vulnerable over the next 3 to 6 months, particularly as those U.S. election risks come more into light. We know, the Trump team has been very critical of Europe. So there are some risks out there that are building that could be dollar positive.
Eric, thank you, sir. Eric Nelson there of Wells Fargo, looking for a dollar that gets a whole lot stronger. The euro breaking down to about 107-ish.
To me, the fact they said that we're late in the global cycle and that basically you're going to get dollar strength as we're late in the cycle. And then you have Larry earlier saying that we're early cycle.
I know.
It gives you a sense. I mean, if your head is spinning, welcome. It's been fun.
And Governor Waller alluding to, not exactly saying it explicitly, that you might get some mid-cycle rate cut adjustments, 1, maybe 2 here and there. Doesn't sound like end-of-cycle type stuff over on the FOMC either.
I keep going back to this panel where I said, where are we in this cycle? And one person said late cycle, one person said early cycle, another person said, what is a cycle? How do we even know that we're experiencing one? Maybe it's sort of a bifurcated.
They got all existential on you.
This is the moment we're in. Everyone's a little existential. How do you benchmark to a time where we've got rolling cycles?
Let's talk about the BOJ just briefly. It's a very difficult position they're in when it's not the priority to stop the weakness. And we mentioned this yesterday. I was thinking back to 2011 and the S&P. The priority was to stop the Swissy from strengthening. And once you know it's the policy priority of a central bank, it's hard to fight that. I think to 2014, when the ECB was fed up of having a strong euro, fed up, sick to death of it, they come out with negative rates. It's hard to fight the ECB and Draghi at the time because the policy preference was to do something about it. I don't think we can sit here this morning and say the Japanese policy preference at the moment is to do something about dollar yen. There's a much bigger story playing out over there.
What Eric said was they're happy with the different price action. Actually, they don't mind the weakening in the yen because it allows some sort of ongoing reflation that they've been looking for. To me, this is a new way of looking at it. Not only are they not committed, to your point, they actually like what they're seeing, and they're not going to try to stop it.
That could change, of course. That's just where we are right now. Coming up on this program, Stephen Center of Kia America on the auto and EV outlook. That conversation just around the corner. Equity futures on the S&P 500 to close out the month of March in Q1. Equity futures down by 0.04%. We are essentially unchanged. From New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Welcome to the program. Let's check out a price action together. Equity futures on the S&P 500 slightly negative, with the emphasis on slightly. We're down by 0.03%. Far more instructive to think about where we've been over the last 5 months or so. Sitting at all-time highs yesterday. I think yesterday the 21st record high of the year so far. We have had 5 months of gains. Over those 5 months, since the end of October, Lisa, stocks are higher by 25%.
Even though bonds are down, even though we've seen yields climb and prices come down, with this expectation that you're not going to get rate cuts, that is the conundrum. What could potentially stymie a rally that was initially on the idea of rate cuts that's now being fueled by pure strength?
Bonds down, yields up. Check out the bond market. 2-year, 10-year, 30-year. The 2-year has risen so far this year over the last 3 months by close to 40 basis points. It's up by another 6 basis points this morning, 462.41. And Lisa, exactly to that point, we have rallied over the last 3 months with high yields. We rallied over the previous 2 months to close out last year with much lower yields. And we're still trying to work out exactly what the relationship is between the bond market and stocks, given that people thought when we priced out rate cuts in 24, stocks would be heading south, not going north.
You ask 3 people that question, you'll get 6 answers. My takeaway is that essentially it doesn't matter. This is the latest sort of zeitgeist, to use Tom's word. It doesn't matter if they only cut once or if they cut 3 times this year, as long as they cut a little bit, because that's their direction. And if they don't cut at all, then it becomes a potential risk. That's essentially the message that we've gotten from a lot of people. I'm cobbling it together and butchering it, but that's my sense.
The growth policy mix, we're told, is still good. They have a bias to cutting and not hiking, and the data's okay for now.
Yeah.
PCE comes tomorrow morning. Chairman Powell a few hours after that. Let's check out foreign exchange. The euro breaking down just a touch. Dollar stronger, euro weaker, 107.88. The yen just a touch weaker, a hint of weakness, 151.39. And we're told repeatedly, I don't know where these numbers come from sometimes, but 152, line in the sand, apparently, for intervention from the BOJ.
And now people are saying, is it really the line in the sand? And this is what we heard from Eric. It doesn't really matter if it gets to 152 as long as it's not rapid. It's sort of slow, controlled climb up. That's fine.
Got to 151.97 yesterday, and they just talked about it.
This could be problematic.
It's going to matter if they get to 152, maybe. Not for me to say. Under surveillance this morning, a salvage firm is now heading to the port of Baltimore to recover the container ship Dali and the collapsed Francis Scott Key Bridge. Federal officials telling Maryland lawmakers it will cost at least $2 billion to replace the bridge, including cleanup. There is still no timeline as to when normal port operations will resume. Insurers facing as much as $3 billion in claims, with Lloyd's of London the most exposed, according to Barclays. AMH, this is what we talked about yesterday. Where is the liability? Where does it sit?
Right, and what we heard from U.S. officials, we heard from Treasury Secretary Janet Yellen yesterday, is that yes, there's obviously going to be some sort of liability on these companies and the insurance companies, but that gap, or potentially waiting for all this paperwork to go through, they say the federal government is going to step in, and we got this $2 billion floating around now. But when you talk to a lot of people, they say this could just be the start of how much this will actually cost.
It takes time to get the money, Bramo, and they need that money quickly.
It takes time to actually remove all the metal. I was reading about the excavation effort and how you get some of this material out to even begin to understand what the mooring is going to look like for the new bridge. I mean, it's really an intense process. I find that fascinating, the excavators that come in and have experience with this.
A 1,000-foot boat, ship, stuck in a bridge. That's not something you clean up overnight. That can take a long, long time, weeks, maybe even months.
And there are 56 containers still on that ship with hazardous materials in there. So they have to get it out without spilling anything. And they have to make sure to do so while preserving any type of effort that could potentially lead to a faster construction of the bridge. Highly complicated.
A massive effort underway in Baltimore. Let's turn to our next story. Fed Governor Waller looking to reduce the number of rate cuts this year or push them out even further. Speaking from the Economic Club of New York, saying, quote, "I see economic output in the labor market showing continued strength, while progress in reducing inflation has slowed. I see no rush in taking the step of beginning to ease monetary policy." Waller going on to say we need to see at least a couple of months of better inflation data. No rush. That's literally his tagline at the moment over the last few months.
That's pretty interesting. Makes headlines, gives people a little bit of nerves, but not necessarily that much. But it does set up the drama for tomorrow when we're all off, when Jerome Powell is going to be speaking and when Mary Daly of the San Francisco Fed is going to be speaking. If they double down on this message, expect a bigger response in markets. Right now, people can sort of shrug off Chris Waller as a hawk. They can't do that if you hear it from Mary Daly and Jerome Powell.
Won't it be nice tomorrow just to hear from Chairman Powell and markets closed, just sort of listen to it? Take it in, think about it, have a few days, come back Monday.
Is that what you're doing tomorrow?
Listen to Chairman Powell. Oh, of course.
Yeah.
I'll be listening to Chairman Powell. Mike McKee's going to break down PCE for me.
He is, and I'm going to listen to it
on
too.
Bloomberg Radio, so I'll be tuning in for that, no doubt. Let's talk about the tension between China and the United States and a sprinkle of EV as well. Treasury Secretary Janet Yellen slamming China's use of subsidies to boost industry. Secretary Yellen speaking at an event in Georgia yesterday saying U.S. manufacturing is facing pressure from cheap imports flooding the market. The comments ranging from green energy products to electric vehicles. Yellen saying this will be a key issue during her next trip to China, which is expected in the coming weeks. Stephen Center, COO and Executive VP of Kia America, joins us now for more. Steve, good morning to you.
Good morning.
Let's talk about EVs. It's fantastic to have you with us, sir. You've got the EV9, the EV6 over at Kia. Can we just start with how they're selling? Because we've heard a lot about pushback in this country. How are they selling?
They're selling very well. We'd like to sell more of them, but I think there's been a lot of expectation about the rate of the transition, and that's unknown. And consumers are buying the car, they're enjoying the car. The infrastructure is the challenge. The whole industry has already received the business from the early adopters. And now we're getting into people that really need the car. This isn't a toy. They need to get back and forth. The thing about range anxiety is true, but it's more about charging anxiety because the cars will go 300 miles, and very few people drive 300 miles at a time. So we're very excited. EV9's won a lot of awards. It's proven what you can do with electric cars, a 3-row SUV with that kind of range.
What are dealerships telling you about what they need right now, where consumer demand is, and how can you meet that demand?
Well, when you talk to dealers, their first answer is discounts, and that's not selling from strength. I think what we need is better infrastructure, and that's where all of this is failing, in a sense, because you can regulate what we build. You can't regulate what people buy. And the big projects like infrastructure that in the beginning are all cash out and then the return is over a long period of time, that's kind of like building highways, and that's what the government should do. And they've really blown it on that.
From a personal perspective, when I was buying a car, it wasn't range anxiety, it wasn't charging anxiety, it was resale value anxiety. The fact that it was probably going to plunge off a cliff if I got an electric vehicle, because right now it's not clear, especially with an 8-year battery lifespan. How do you address that? The fact that these cars are not as valuable when you resell them, and potentially there could be new technologies that come down the pike in that time.
Absolutely, and when you're buying electric cars, they're probably more like tech products than they are normal cars. Perhaps the ownership method's going to change, and you may lease the car, you may be the first lessee on the car. You may come back at the end of the lease and get a complete refitting and tech upgrade like an aircraft does, and then there'll be a second lessee and you recondition the battery. So there's a lot of change coming in terms of how you do things. And it might be that you don't own them. And in a sense, you don't own a car when you buy it. You only own the life of the car.
You know, John's been on this point for a long time, and he's absolutely correct. It raises this question if policymakers have gotten it wrong. If basically the car makers were pushed into manufacturing vehicles where there wasn't the demand yet, and it wasn't clear that that was the right pathway, when there could have been better ways to get to a more efficient future. Is that accurate?
Absolutely. I mean, we're being told what to make specifically. And there's many ways to skin that cat, so to speak. And if you talk to engine designers and emissions engineers, there are many things they can do to clean up the cars. And there's different technologies. Batteries one, there's fuel cells. And hydrogen fuel cells are really wonderful. Their emission is water. And they're silent, and the question is where to get the hydrogen. And I've worked on hydrogen cars for a long time, and that infrastructure is even less mature than the battery charging infrastructure. So I tell everyone that I can find in the government, you need an Oppenheimer moment. And you need to feel the crisis, and you need some leadership to manage the change.
The U.S. government now has subsidies for the EVs, and then the EPA, many people say this is basically a mandate. These are the strongest pollution standards we've ever seen in the United States. So what should have they done first? Because it seems like what you're saying is they got it backwards.
Yeah, well, there's a lot wrong with the regulation. And if you think about it, you've got 3 different groups regulating the auto industry, at least 3, at least from the emissions. You have NHTSA, which is regulating CAFE, which is a fuel economy. You have EPA for exhaust gases. And then you have California steering from the back. And they're requiring electric vehicles. And there's other states that jump on that rule, and they're not doing anything about the infrastructure. And the challenge you have is you've got too many sets of conflicting rules. And in the case of electric vehicles, the point is to reduce the CO2. And CO2 is not a local problem. When you fly over the country, you don't see the lines on the ground. It's a global problem. So California is a big EV market. You know what, like the number 3 and 5 are? It's Texas and Florida. They're not ZEV states. And my attitude is, well, let people buy them where they want to buy them right now, and let's get the job done. So tell the automakers the percentage of EVs you have to sell, it's for the whole country. Don't create these silos and buckets. That's killing the industry, and it's impossible to manage that.
The Biden administration has been very happy with the Inflation Reduction Act, able to get over the finish line, but Trump is threatening to ratchet it back. How concerned are you about that?
Yeah, so someone asked me last night, what's the biggest threat that I see in this business? And I said it's an existential threat. And they said, oh, is it China? Is it something else? I said, no, that's competition. We're okay with that. It's government policy. And this whipsawing, we're making decisions that last 30 or 40 years when you build factories and establish supply chains. And to have the government policy change from on, off, it's nuts. It's just nuts.
It means you need to be really nimble. So can we talk about the EV plant in Georgia? Can you tell me whether that's going to be dedicated to battery-powered vehicles or not? How flexible would that plant be?
So that's a great question. The original concept is EVs, and it also includes a battery plant. So because you always want to have the big, heavy components right near the factory. It might be in the future, because you always want that factory running full speed with everything you can do. It might be we also build other cars there. Now, we have another factory in West Georgia that's been around for a long time, and we built Telluride and Sorrento and other great cars there. One of the things that we've done is we made room, and we're building EV9 there now. So and most of an electric vehicle is the same as internal combustion. At some point, it goes this way or that way. And we're building EV9. We're going to introduce it later this year. So it might be that we're going to balance the capacities with other products.
How easy is it to do that? I've tried to get some information, some clarity from GM and struggled, so maybe Kia can help me out a little bit more. To toggle between hybrids, EVs, and internal combustion engine vehicles in a single plant? How easy is it to toggle between the three?
The biggest hybrid vehicle isn't that different. So it has an engine, it has a fuel tank, it also has a electric motor attached to the engine and a battery pack. It's a smaller battery pack. An EV is a totally different beast because it's driven by electric motors at the wheels. So at some point when you're building the body and the car, it's either going to be born as an EV or born as internal combustion. And that's where the difference is. So at some point on the line, you go this way, you go that way. I think the biggest challenge is the supply chain because you have different parts. So you have to have different motors coming in and battery packs. But inside the factory, you're either jacking up engines or you're jacking battery packs in. And it's not that exciting.
When you talk about the supply chain, you mentioned this earlier, you don't worry about China. That's just competition.
Right.
Do you think increasingly the gating off of different auto industries, depending on the country, is problematic for your business, even if it might benefit you in the short run in terms of, restricting competition on the margins with certain areas?
Yeah, well, you don't. My background's in economics, actually, and you don't want to restrict competition because it breeds laziness and weakness. So competition's a good thing. You don't like it when somebody can beat you, and often you get beaten because of differences between the nations, and you just have to get better.
Steve, this was one of the most revealing conversations, honest conversations I've had about the automakers for a long, long time, and appreciate the transparency. The policymaker, it appears, has put you in a very, very complicated place, and we appreciate your time this morning, sir. Thank you.
My pleasure.
Thank you, Steve. Stephen Center there of Kia America. Equities right now just about unchanged on the S&P. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Hey, Yahira.
Hi, John. Former U.S. Senator and Vice Presidential nominee Joe Lieberman has died. He represented Connecticut in the Senate from 1989 to 2013 and was Al Gore's running mate in the 2000 presidential election. Over the course of his political career, Lieberman moved from reliable Democrat to centrist independent, supporting Republican efforts like the 2003 invasion of Iraq. Lieberman was 82. Discover Financial Services CEO Michael Rhodes is leaving the credit card company to lead auto lender Ally Financial. He will be replaced by Michael Shepard as interim CEO on April 1st. Rhodes has been in the role since December and wasn't expected to be at the firm long term. In February, Capital One agreed to buy Discover in a $35 billion deal. President Biden is set to raise $25 million in a single day as he campaigns across New York City. Biden is raising money alongside Barack Obama and Bill Clinton at a Radio City Music Hall event. The effort is designed to help expand Biden's already large cash lead over Republican presidential candidate Donald Trump. The showing alongside two former presidents giving Biden an institutional backing that Trump lacks due to his estrangement with big GOP names. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. The only thing I can think of is traffic, Midtown traffic. Up next on this program, Fed Governor Waller in no rush.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
That conversation up next, live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg.
Inching back just a little bit on the S&P, down by 0.05%. Yields bleeding just a little bit higher, up 2 or 3 basis points. Crude higher too, up by 0.9%. Let's call it 1 percentage point higher, 82.12 on WTI. Under surveillance this morning, Fed Governor Waller in no rush.
I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy. In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
Here's the latest this morning. The Fed's preferred inflation metric, core PCE, due tomorrow morning at 8:30 Eastern Time. Bloomberg Economics expecting another hot print, calling for the biggest monthly increase in about a year. Constant Hunter, Macro Policy Perspectives, in line with the estimates, calling for a 0.3% uptick, but still expecting, quote, continued moves in the right direction on monthly data that should give the Fed confidence to cut in June. Constance, I'm pleased to say, joined us now for more. Constance, great to catch up with you. We'll talk about Governor Waller's comments in just a moment as well. Let's start with the data tomorrow morning. We've had PPI, we've had CPI. How do those two reads inform what we'll get from PCE tomorrow morning?
Sure. Well, PCA is a bit broader, but many of those inputs do feed in. And so that seasonal effect that we saw in January and then a little bit continuing in February will feed into PCE. On the good news front, we are expecting rents to finally come down. I know this has been a bit like waiting for Godot, but we are expecting that to be a significant factor as we move into the second and third quarters of this year. In addition, we are expecting vehicle prices to remain fairly soft. And then the real question comes in other sorts of services prices like insurance, which of course, if you think about auto insurance, was heavily influenced by the rise in prices of vehicles, prices of parts, and prices of labor. All of that has moderated, and we're expecting that to feed through into vehicle insurance as well.
You said that you think that this will give the Fed confidence to cut in June. Do Chris Waller's comments change your view at all? That we heard yesterday him saying that it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data?
So a few things on that. We don't expect tomorrow's data to necessarily give them confidence. We expect data that will be forthcoming in the time between now and June to give them confidence. And it is the Fed's job to take the data pretty much at face value. I mean, you saw Powell speak a little bit about the seasonality factors, but we need to be, they need to be cautious and prudent with regard to that. And I think Waller was laying out the case for that last evening. On the other hand, the Fed is data dependent, and he also said that as the data come in, it will cause them to inform what actions they actually take.
Are you surprised we haven't seen that weakness yet, Constance? A lot of people had expected to see the disinflation in a much more aggressive way early this year. We're now seeing inflation in commodities across the board. Goods inflation seems to be picking back up, and people are worried about, some type of even housing price increases in certain regions. Does that give you pause at this conviction that the data will weaken enough by June?
So let's take those one by one. Certainly, commodity price increases do eventually feed through into PCE and CPI. Obviously, not right away into the core, and they haven't been going up. Well, there's some commodities. If you look at cocoa, you look at copper. Of course, they've been going up very swiftly. But if you look at the broad basket, not so much. If we consider rents, yes, we've been waiting for those. Yes, we were expecting those. But again, that beginning of the year data can be a little lumpy. We saw this last year as well. And then with regard to housing prices, let's remember that, you know, the BLS disaggregates the two components that make up housing cost and housing price inflation. It disaggregates the consumption portion and it from the investment portion. And so those house prices that are going up in the marketplace are not what gets fed into CPI and PCE. And so from the perspective of the Fed, actually lowering rates would likely increase housing supply at the margin, which would have an equalizing or downward pressure on prices.
Could we just sit on commodities for a moment? Because JP Morgan yesterday upping their target for oil to hit $100 a barrel. How much of a headache is that for the Fed, given the fact that something like oil has a read-through across the space when it comes to other products and goods?
Yeah, that's a great question. So if we look at oil prices on just about any metric, on a real basis as opposed to a nominal basis, remember all these commodities are quoted nominally, they really haven't increased that much over time. They also haven't decreased that much over time. They've been fairly steady. And so yes, that will in the near term feed through into prices. The question is how quickly we get to $100, right? If we are a slow creep to $100, we will have an opportunity to adjust. If it is a swift and sustained move to 100, that is a different story.
But if it's this summer and the market is expecting June, does that mean the Fed may actually have to distance itself yet again?
Yeah, I mean, I will just say that forecasting oil prices is a very, very tricky thing to do, and it's very possible we do get to 100. That would feed through into higher gasoline prices, which of course would cut demand for other goods and services, right? Because so many people need to use their cars to get to work, and we still have a predominant internal combustion engine fleet. Although if your previous guest has anything to go by, that'll be slowly going away. So yeah, I mean, it could cause the Fed to pause. I don't think it's going to be the primary thing they're going to be looking at. If we're moving in the right direction on PCE and core PCE, 125 basis point cut is not going to change the trajectory for the oil market.
Constance, appreciate your perspective and opinion this morning. Thank you. Going into PCE data tomorrow morning. Constance Hunter there of Macro Policy Perspectives, following that speech, Bramo, from Governor Waller.
It's very difficult to understand how to take data at face value. Do you take it at face value when you take the seasonal adjustments out? Do you take it at face value when you just look at the path of inflation? Do you take it at face value when you know that there are certain areas that are going to disinflate over the next couple of months? This is such a fraught moment, and it raises the question of who do you pay attention to in the Fed, and are they going now on ideology more than just data dependency?
Do you think some of the hawks on there might trade an earlier cut for fewer cuts with some of the doves on the FOMC? Is that the grand compromise?
You think it's going to be like a poker table?
I'm just
I'll give
saying
you your cut, and I'll raise you, no more.
The chairman seems to really value consensus. I don't think he wants to descent on that first interest rate cut. I think around June, if you get that cut, that's one way of coming to an agreement. Look, we can go earlier, but ultimately it's going to mean fewer for 2024.
Raphael Bostic set this up because he's talked about how he only wants one cut, and he's the one who said he thinks we can be one and done for a while. It's a good question.
See where that conversation heads. In the next hour on Bloomberg Surveillance, Jenny Johnson of Franklin Templeton, Mario Parker of Bloomberg News, Oscar de Bock of DHL, Luke Hickmore of Aberdeen. It's been a while. Haven't spoken to Luke for a while. Looking forward to that. Equity futures on the S&P 500 shaping up as follows, just about unchanged after another solid month of gains. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's pretty hard to bet against U.S. stocks here.
The U.S. growth aspects remain the strongest in the world.
I think we're seeing a broadening of the overall market, but we still like the U.S.
Effects of high interest rates just haven't done nearly as much damage as we would have thought to the private sectors.
All of these things say that there is a feeling that the market isn't invincible.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Equity futures slightly negative on the session, up big time on the quarter. Bramo, we're looking at a fifth month of gains on the S&P 500.
And gains that are finally broadening out. People have been asking for broadening out for quite a while. Well, you got it. Congratulations. You're still seeing the Magnificent Seven crushing it, up 17% so far in this quarter. But you are seeing other areas, in particular industrials and in particular energy in some of these places, take up some of the slack.
So what's the rush to cut interest rates? Governor Waller answering that for you all in a speech at the Economic Club in New York yesterday evening. No rush, that phrase coming up 4 separate times in that speech yesterday. I think that tells you everything about his position.
And it tells you everything about how people read everything the way they want to read it, because you have people coming out and saying there's no rush means they cut in June, and then they see whether they cut again, and other people say, wait a second, maybe he's saying that they don't cut at all this year. It's basically the way that this whole year has gone. We hear Fed speech, we get economic data, and then people take it and they fit it into the thesis that they had earlier in the year. And that's basically where we are right now.
More inflation data tomorrow morning. Just reflecting on the inflation data we've already had. Anne-Marie, in this speech, recent inflation updates, disappointing. In this speech, the conclusion, delay or reduce the number of cuts in 2024.
The one thing he did talk about was a little bit softness on the retail sales, though, but then he said it's not significant evidence of a slowdown. He said that evidence is too sparse. But you brought up a great point, Lisa. All this really started with Raphael Bostic, basically saying maybe it is going to be one and done this year. I liked what Greg Valliere said. I'm going to have to put a little politics into this. He says, of course, we believe Fed officials when they say political considerations don't affect their pre-election policies. But he says initial rate cut on September 17th and 18th could be awkward. That's to say the least.
And let's just say if you're only going to go once, and let's play into that theme. If you are only going to go once, maybe it would make sense that you avoid the election period altogether.
So you've come up with this thesis that basically the Fed is like a poker table where they're trying to like negotiate rate cuts and the timing, and that basically what they're consolidating around in the Pharaoh world is that you have the hawks. This is the Pharaoh world. The hawks saying, okay, we're going to cut once. June's a good time to do it, and then we're not going to cut again. So we'll give you your dovishness with the cut, but take our hawkishness later in the year with no more cuts. So I think that that's the Pharaoh base case right now.
I'm just listening to what they're saying. I'm just going off what Governor Wallace said yesterday, which basically is the grand compromise. And he came up with this, which is either fewer or later. And I think if they go earlier, they lean into June, then you might end up with fewer. It might make sense at that meeting for that median dot to shift to, say, towards 2. I've got no idea where the economic data is going to be between now and then. I'm just listening to where the commentators are coming in, the officials and the FOMC. That seems to be the direction of travel.
If that's the case, should the 2-year be a lot higher? And that, I think, is going to be an increasing question. If that is truly the case, does that mean that the neutral rate is substantially higher than it has been in the past? And does that reset expectations, actually, oddly, in a more material way?
That's the debate that we'll have, but certainly over the last 3 months through Q1, yields have been shifting higher at the front end of the curve. Equities at the moment on the session, doing okay, no drama here, just about unchanged on the S&P 500, negative by 0.04%. Yields a bit higher by 3 basis points, 421.80, and that really the story of the first quarter, Lisa, just how well this equity market has stood up to yields repricing higher and pricing out rate cuts, not pricing them in at the Federal Reserve.
Yields are rising because of strength. It's the good kind of rising, and that's basically what people have hooked into. When does it become the bad kind of rising? People talk about the potential for 435 on the 10-year. There are all these levels, but the narratives, again, I keep going back to it. If a narrative has enough legs to it and is strong enough, it can persist for longer than the data can change or continue to go with it.
Just sort of market to market the commentary over the last 3 months, haven't we?
100%.
Because the last 3 months has been very different to the last 2 months of 2023. Coming up this hour, fantastic lineup for you. Jenny Johnson, the CEO of Franklin Templeton, as Governor Waller pushes back on rate cuts. Bloomberg's Mario Parker as Janet Yellen sounds the alarm on China. And Oscar de Bock of DHL Supply Chain as the Baltimore port remains cut off. We begin with our top story, wrapping up a quarter that felt like a year. Stocks posting another all-time high as hawkish Fed comments muddied the path to rate cuts. Jenny Johnson, the CEO of Franklin Templeton, saying this: we see a dovish but pragmatic Federal Reserve. Rate cuts may not occur as soon or go as deep as markets are currently projecting for this year. To talk about the whole universe, Jenny, I'm pleased to say, is with us around the table. Jenny, good morning to you.
Good morning.
Thank you for being with us. I want to start with this sort of really big picture stuff. How do you and the team think about investing over the next 10 years compared to investing over the previous decade or so? How different is this going to be?
I think it's very different. I mean, this is where I think it feels really good to be an active manager, right? Because you've just come off a decade where money was free. You didn't earn anything in the fixed income market, so the obvious place to go was the equity markets. And when you do that, you have a momentum market, and passive outperforms in momentum markets. And if you were lucky enough, you could qualify for the private markets, and then you got excess returns there. Now it's much tougher, right? And I still think that actually I was listening to the two of you back and forth on the politics of where the Fed's going to go, which is all the reason why I would say the best thing for the Fed to do is to ignore the politics of the election and really look at the data. And I do think if they look at the data, I'm a believer that it's probably September. Our first rate cuts are probably in September. And frankly, maybe 50 basis points, maybe not the 75 that people think. And it's, there are still 1.4 jobs for every one person looking for a job. Wages are still increasing. You saw a story with Europe stocks, the projecting on earnings of European companies, and it's because the U.S. consumer is still strong. So, I think this next decade is going to be all about risk-adjusted asset management and active management.
You introduced the political conversation, so let's go there. You think they should ignore the politics. Can you personally ignore the politics?
I think if you're the Fed, the best thing, in the end, you can never defend yourself if you've allowed the politics to infiltrate your thinking. And so the best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing. So, take out the politics in your decision-making process, and then you can stand by it.
That said, that's for the Fed. As an investor, though, politics actually has a very legitimate influence on markets, especially right now with industrial policy and people saying that that's just the beginning of a whole host of money where we actually have to realize that our economy is held up by nuts and bolts as much as it is by the pixels on your phone. How much is that changing your thesis in terms of how you invest, the asset classes, and where you're directing money?
Sure. I mean, I actually think that we've done acquisitions in the private markets. The change from public markets to private markets, I think, is directly related to what has been political policies. So just take private credit. Banks are not lending in the way that they used to lend. People get nervous because they say, look at this growth of private credit, but really it's just shifted from the bank's balance sheets to the private markets. And that is a direct reaction to the capital requirements that have been imposed on banks. And so, we manage about $78 billion in private credit. You look in 2024, I think only 10% of direct loans have come through the banks that are syndicated. The rest go from the private markets. You look at the private equity market. Look, it's tough to be a public company here. You see CEOs who have the choice to waiting longer to go public. And so all of those excess returns in the early years are being captured in the private equity market. And I think, again, that's a bit of the politics that has become, imposed on public companies. And yet the average investor needs to be able, they invest in mutual funds and ETFs. Those are only investable in the public markets. And so we actually should encourage and create opportunities for companies to go public versus creating an environment where we're constantly attacking public companies.
The key executive was just on the last hour saying how basically it's hard to plan 30, 40 years out when regulation is constantly on and off like a light switch in Washington. John's asking about 10 years out. How do you look 4 years out, especially with a change of a president in next year from November?
Well, I think we probably do look 4 years out as you're making investments. I mean, the thing not to do is be a day trader where you're trying to just up and down jump. We're longer term investors. And so the investment thesis are going to be anywhere from 3 to 10 years, depending on what company they're investing in. But it's difficult. You have to look at markets. I mean, he was talking about the EV market and, as all of the politics that go behind that, you're going to be focused on all the policy that comes in. Similar to banks, honestly, it was pretty quiet for banks for a long time until you had Silicon Valley Bank blowing up, and then boom, you're in with a bunch more regulations. So you try to pick your sectors and understand how quickly the politics are going to impact the investment in the short and longer term.
Jenny, you were talking about some of the money shifting towards private markets. I believe you've overseen about 10 strategic investments and acquisitions in your tenure as the CEO. How do they complement maybe the shifts of capital in U.S. capital markets? I mean,
so our acquisitions have all been what we think are secular shifts in that. So one is, again, I talked about this private market. So, and actually, I think right now private equity is going to be sort of a challenge, right? With interest rates up, you've seen the private equity firms that have excelled. Well, when cash was free, it was hard not to do well. It's going to be a different story now. We bought secondary private equity, and for a variety of reasons, supply and demand, I think it's a great place to be if you want exposure in that part of the market. So in the private markets, again, I think there's a shift towards capital. But the other thing that's happening is the massive advances in technology are creating it so you can have truly customized client portfolios in just a way that we've never been able to do. And so, we have a AI application called Go. It's a Go's optimization engine where you literally, a financial advisor, can customize a client's portfolios based on their individual goals as opposed to one portfolio. And it dynamically shifts based on the time frame and the risk of that particular goal. That kind of customization is real, and tax optimizing it too for the individual. That kind of customization is going to be a real win, I think, to investors, and it's enabled by technology.
When you talk about the AI technology, but also the 10 strategic partnerships or acquisitions, are there more to come? Is this the best way to really access new markets and new expertise?
I think it's important it's difficult, say, to grow organically in new areas. So our big alternative investments were in real estate, private credit, and secondary PE. The other area that we've said we think there's growth opportunity that we would be a potential buyer would be in infrastructure. And so, that would be kind of the last to fill out that product gap. Our acquisition recently of Putnam Investments brought actually traditional capabilities in the retirement and the insurance, which is an important channel for us that we'd probably been underrepresented in. So we're looking for those things that help to fill gaps that we have. And I think the good news is we probably have the broadest investment capabilities of any asset manager. And so we don't need to do any acquisitions. And now it's about finding ways, and we just recently had one of our private credit manager, the CEO, said, you know, it was great. Franklin bought us in 2018, Benefit Street Partners, and you know, you helped us with distribution, but now because of AI and the cost of data and the expertise that's required there, we realized we would not be able to do that on our own. So being part of a $1.6 trillion platform that can invest in these and then have the boutique managers is a real advantage.
This really raises the point that I was getting to, which is some people are wondering whether the biggest players in the space have a disproportionate advantage because they do have economies of scale, because they do have that scope of data to use for the machine learning programs. Do you think that this is going to be how it sort of is that sort of smaller boutique fund managers have to partner with big funds, big firms, in order to survive this new era?
I mean, you definitely see distribution partners wanting to narrow the number of asset managers that they work with, just because it's complicated for a variety of reasons. You have to do the same amount of due diligence on a small manager as a large manager. And as I mentioned with AI, not only is the cost of external data very expensive, but the ability to train your own AI models by having more data in-house is a real advantage. And for us, having it in all different parts of the capital stack is a great opportunity and advantage. So I think that's where it becomes an important advantage to size. And then honestly, things like blockchain. I mean, I'm a big believer that there's going to be new types of products that are introduced because of this technology. The work that we've been doing, we have a tokenized money market fund that we launched, our Benji app launched, I think in 2020, approved by the SEC. But for us, it's going to be the interesting follow-on projects. Now, we're probably not going to be material in earning money from this for 7+ years, but you have to get that knowledge today. That's harder for a small manager to spend their time in kind of an R&D on that.
Can we finish on stock picking, but of the sporting kind? Can you tell us the secret sauce to Brackets for a Cause to March Madness? I've got the details in front of me. You won the men's bracket in 21, tied for first place in the women's bracket last year. Why are you so good at this?
Hey, just like active management comes down to a great team, I have a great team at Franklin Templeton who give me great advice.
How big is the team? You've got 14 people
the ones
doing
that feed
brackets.
into it are probably, and then, by the way, so many people like leverage their quant team. Mine's like the communication and D&I team. So it's about, I'd say that there are kind of 5 core people that help me fill it out. Okay. And I'm sure they get advice from a few others.
I'm coming to you for help next year because I'm absolutely dreadful at this. Jenny, this was great. It's good to see you. Got to do it again.
Thank you for having me.
Thank you. Jenny Johnson there, the CEO of Franklin Templeton. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Former crypto mogul Sam Bankman-Fried will be sentenced today over his role in the 2022 collapse of trading platform FTX. Bankman-Fried was convicted back in November of fraud and conspiracy, with a jury finding that he illegally used money from depositors to cover personal expenses like the purchase of luxury property. Prosecutors recommending a prison sentence of 40 to 50 years for Bankman-Fried. His family and friends urging leniency, saying FTX investors have largely recovered their funds. The ECB will allow Greek banks to make their first shareholder payouts in more than a decade, according to Bloomberg reporting. The last time a Greek bank paid a dividend was in 2008, ahead of the global financial crisis and before the country's debt crisis started in 2010. The bank payouts expected to come after Greek banks reduced their non-performing loans and increased their financial strength. Towns across America are preparing for a potential economic windfall with a solar eclipse scheduled to pass across the country on April 8th. The last eclipse in 2017 was lucrative for some states, with South Carolina's tourism department estimating a $269 million economic impact from around 1.6 million people traveling to see the eclipse. Rochester, New York is one city on the eclipse's pathway this year, with officials there anticipating as many as 500,000 people will visit in the hopes of seeing it. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, Secretary Yellen taking on China.
We've raised overcapacity in previous discussions with China, and I plan to make it a key issue in discussions during my next trip there.
That conversation up next, live from New York City this morning. Good morning.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Quiet start to the morning. Good morning to you. Welcome to the program. Equity futures negative by 0.04%. No drama there. Yields are higher by 2 or 3 basis points. Let's call it 422 on a 10-year, 421.61. Under surveillance this morning, Secretary Yellen taking on China.
China's overcapacity distorts global prices and production patterns and hurts American firms and workers. We've raised overcapacity in previous discussions with China, and I plan to make it a key issue in discussions during my next trip there.
Here's the latest today. Treasury Secretary Janet Yellen sounding the alarm on China's industrial push, putting the issue front and center ahead of an expected visit in the coming weeks. Bloomberg's Mario Parker joins us now for more. Mario, great to catch up with you, sir. China actually snapping back, in fact, going first in the last 24 hours with comments about the Inflation Reduction Act. Those comments not unique, shared by the Europeans as well, Mario. How much tension is there between the US, Europe, and China on this front?
Well, there's quite a lot of tension there. I mean, the fact is that you've seen Janet Yellen regularly now out in her visits across the United States kind of take aim at China and some of its economic policies. President Biden has also featured China rhetoric about China and its unfair what he describes as its unfair trade practices on the campaign trail as well. So no, tensions are very high, and and one of the issues in an issue, and it's very bipartisan in Washington right now. Even as acrimonious as the political landscape is, there is bipartisan sentiment around these issues.
The geopolitical situation is acrimonious, but Xi Jinping met with a number of business leaders, and Steve Schwartzman, speaking to Bloomberg following meeting Xi Jinping, said the feeling I got is that, at least from President Xi's perspective, they're very open to attracting foreign capital. Is there any lane that we can see with this upcoming trip from the Treasury Secretary that we could potentially get something positive coming out of this relationship between Washington and Beijing?
Well, Anne-Marie, one of the things that Janet Yellen has tried to do is tightrope, right? So while we say that she's had more terse language toward China, and the administration has as well, it's also said that it welcomes healthy competition, that it wants to have a competitive environment with China, a fair and competitive environment with China, but not decouple from China, right? That's the key word there. So there's an understanding of just how dependent the global economic landscape is on China, but again, the U.S. is trying to make sure that it's measuring that some of that rhetoric there.
Mario, I'd like to change topics into what's going to be happening in New York City today. We have President Biden coming. He's going to be flanked by Obama and Clinton. We have Leon Panetta, who worked in these administrations of both former presidents, saying there's everything to be gained by Biden standing next to Clinton and Obama. How difficult, though, is this split screen going to be when the former president is also in New York to attend a funeral of a police officer that died while on duty?
Yes, it's a sad situation, first of all, but then there is politics. This is a 2024 election year, right? So we've got, on the one hand, we've got Joe Biden showing that he's essentially coalesced the Democratic Party. There were questions as to whether or not he could do that just weeks ago. Donald Trump, in the last 24 hours or so, has pointed to this fundraiser that Biden, Obama, and Clinton are holding in New York. So it shows that it has gotten under the skin of the former president. Meanwhile, with him visiting or attending that funeral, I mean, it does essentially bolster some of his bona fides on criminal justice, crime, et cetera. That's an issue that he wants to run on. It was also a liability for him, given, remember, about 4 or 5 years ago, when he was in office, he authored the First Step Act, right, that allowed for some of these people who have been arrested to get back on the streets as well. So this is a political liability that he's trying to cover up also.
When it comes to the campaign, and Biden's going to be having this huge fundraiser today, can you give us a sense of how far apart these two individuals are in terms of their war chests?
Oh, they couldn't be further apart. President Biden has about 3 times as much cash as former President Trump at this moment. Just alone, this event today, which is a star-studded event up there in New York, is going to raise $25 million, according to the campaign. That's more than double the amount that former President Trump raised in February, for example. He's cash-strapped. The split screen is the fact that 3 days ago or 2 days ago, former President Trump was in a New York courtroom asking for a reduced bond because he couldn't afford it. Meanwhile, his key adversary, President Biden, just has an embarrassment of riches right now.
Mario, I've got to ask this question. It just popped into my head. It seems quite obvious. Does Bill Clinton still help people raise money? Does that actually help them?
Bill Clinton does still help the party raise money, indeed. When you look at it, right, so you've got a few tiers in the party. Even though Joe Biden, of course, there's questions about his age. He's the oldest of the 3 men. There's the Obama coalition that he formed in 2008, carried in 2012. Then there's the Clinton. There are still Clinton Democrats out there as well, those more centrist Democrats also who remember those years or look back on those years fondly when he was in office from an economic and policy point of view. So you're essentially got 3 tiers of the Democratic Party represented there between Biden, Obama, and Clinton. You need all 3 for November if you're going to return to the White House for Joe Biden.
Mario, thank you, sir. Mario Parker on that big fundraising effort a little bit later on this evening in New York City. President Bill Clinton, Obama, and President Biden.
I mean, if people know who they are, they raise money. I guess that's sort of the bottom line.
Just wondering, quite a controversial figure in years gone by as well.
Since when has controversy been
not
a problem
exactly
in
the
politics?
person you called to help raise money?
This is true.
There was a lot of whispers about people in the establishment saying Biden should step aside. With this photo today, he's pretty much saying, I've coalesced everyone within the Democratic Party, to Mario's point, and they're all backing me to be president.
Everyone who came before.
Sure.
Not necessarily how the party is changing now. And I think that's part of the... Yeah.
So well said. Bramo, so well said. Yeah, okay.
Let's move on.
Coming up, the CEO of DHL Supply Chain, Oscar de Bog, with the Baltimore port remaining closed. Plenty to discuss on that front. From New York City, with equity futures on the S&P 500 just about unchanged this morning, we're down by 0.02%. From New York, this is Bloomberg.
times in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It is a sleepy start to Thursday morning. Good morning to you. Equity futures just about unchanged on the S&P, on the Nasdaq too. In the last 24 hours, another close at all-time highs on the S&P 500, heading towards a fifth month of gains. You know the numbers since the end of October, a move of 25%. It's been quite a rally in the bond market. It's been a very different story to start the year compared to the back end of last year. 462.21 on a 2-year. Lisa, yields up 5 basis points this morning.
Are you not entertained? You're just talking about how many 20-something record highs on the S&P. Bonds, yeah, they've not necessarily done so well. You've had a loss so far year to date and a total return level, but people have just moved on. They're basically saying, we enjoy the gains and we're going to keep them going.
Listen up, Russell Crowe. I have been entertained. It's you that's been bored over the first quarter.
Well, you sounded like you weren't that entertained. I'm just saying, you know, a lot of people, it's like, oh, another record high. What else is new?
Turn to foreign exchange. It's dollar yen entertaining for you, okay? 151.37. Unchanged on the session.
Is that entertaining to you?
Plenty of action in the last 24 hours.
True,
I'm just going to get to the top stories. Bramo just wants to get to the weekend. Under surveillance this morning, Fed Governor Christopher Waller given the strongest indication yet that the Fed could delay rate cuts, calling recent inflation data, quote, disappointing, saying he wants to see at least a couple months of better inflation data before cutting. The comments coming ahead of the Fed's preferred inflation gauge tomorrow morning, followed by comments from Chairman Powell later on that day. Governor Waller, this is from Neil Dutta. I like Waller, but I like Powell more. Highlights this in his note this morning. While he may be sharing it publicly now, this leads me to believe that Waller already made the case around the table at the March FOMC confab. We know how Powell's press conference went in that meeting. More weight for Neil on Powell than on Waller yesterday.
And it doesn't change anything to hear Waller say what he said, because he is a known hawk. And that, to me, is kind of the point. And actually, we can get the gut check tomorrow. If Powell has changed his tone, well, he's got an opportunity to say it when everybody else is home, because we're not going to be here.
Big chance following PCE. You're not coming in, joining Mike McKee, break down that data?
I don't know.
Bloomberg Radio.
I haven't gotten the call. Don't call me.
You don't want that call. Shares of the iPhone maker on high, soaring to record levels in Taiwan as demand for the company's AI servers overshadow any concerns about a sluggish recovery in the smartphone sector. The company's shares taking off in the past month, gaining more than 50%, despite slumping sales out of China for Apple's iPhone, and despite the fact that Apple's down double digits, Anne-Marie, year to date. The start to the year, if I'd said stocks will keep on rallying, I'm not sure you'd have Apple down as much as it is so far in 24.
It's been a downpour. That's what people are talking about, a downpour when it comes to Apple. There's the regulatory concerns on both sides of the Atlantic, and then, of course, it's these concerns in China. How do you compete with Huawei when it's a cheaper model? And we saw Tim Cook there trying to wave the flag to make sure. What I found interesting about this company specifically is that it seems to be all about this AI hype. But in the JP Morgan note, they say it's likely to remain their AI exposure at 10% to 12% this year, compared to 20% for its other competitors. But just seems to be all this AI hype, and Apple.
That stock, record high, Lisa.
I was looking at who their partners are, and instead of Apple being the exciting one, it's Hewlett-Packard. I mean, that's how we're talking about right now. Hewlett-Packard is the big order flow from Hon Hai. So, you know, the tables have kind of flipped.
Stock is down about 10% on Apple so far year today, which has just been amazing. Need to talk about difficulties in international trade. Details beginning to emerge on the scale of the rebuild required after the collapse of the Francis Scott Key Bridge in Baltimore. Officials estimating a replacement could cost at least $2 billion, while insurers are facing claims of as much as $3 billion for cargo on board the ship, according to Barclays analysts. One detail that remains unknown is how long it will take to reopen Baltimore's port and how that could affect supply chains along America's eastern seaboard. Joining us around the table for some insight is the CEO of DHL Supply Chain, Oscar de Bock. Oscar, good morning to you, sir. Thanks for being with us.
Good morning. Pleasure to be here.
Just how far down the supply chain do you expect to see some impacts, some ripples, consequences fall out from what's developed this week?
Yeah, the thing is the main impact of this one is more in the automotive roll-on, roll-off. It's less on the container part. Of course, there is a container element in there. Actually, we got a few containers on the ship as well, which we need to manage at the moment. But I think if you see one thing, and we were discussing that earlier, if you see one common theme in supply chain management over the past 4 years, is that ability to fast respond, that agility to fast make changes into how a supply chain is organized. And I think that's what you're going to see here as well. You're going to see a shift from container movements from this port to other ports. You're going to see. So I think while the impact to the port itself is dramatic, while obviously the event itself is tragic, but the overall impact on the global supply chain and the US supply chain, I think will not be as large as you would fear.
You mentioned you've got some containers on the ship. Can you just walk us through how those conversations go in the last couple of days? What are the communications like?
Yeah, I don't. Obviously, I've not been directly involved in the discussion on that. But I mean, it's a few containers, so it's not compared to the number of containers we have there. But one of the things is you need to make sure of how we get them released and how we can find alternative routes for them. How we make sure that our customers can plan the products that are in there, alternative routes, alternative plans, alternative products. So to keep those supply chains running. And I think the main, I was saying that probably of a last interview with Bloomberg at the time, where I said there is something around the corner in supply chains every time, we just don't know what it is. I could not have guessed that now we will be talking about obviously this event. And I think one of the main things that you see is that both our customers and ourselves, but I would say everybody working around supply chain, but actually also everybody working in other parts of our customers, is now far more attuned to having to respond, fast decision-making, using data to make sure that we can have the alternatives and fast found alternative solutions, how to manage the supply chain. Because I think this is one of those events that there will be happening.
Which raises the question of how much you have to sort of create redundancies inherent in your supply chains and in your system in order to be flexible to handle, say, a 2-hour delay because you've got to go a different route around Baltimore and get into Washington, D.C. Things that seem like they'd be disasters if I were traveling with my kids, but you have to manage and make the time seem the same.
Yeah, and I think that is a very important point where in the past, let's say more than 4 years ago, it was all about just in time, right? It was all about having the lowest stock levels possible, having the most efficient and cost-effective supply chain. What you now start to see is it's far more about the resilience of supply chains to make sure that they're organized in such a way that you can respond to these things. Because if you got your minimum stock levels, then obviously a 2-hour delay is actually dramatic. If you make sure that you build the supply chains in such a way that you can respond to that, it already helps. And I think that's something that you see happening at the moment, is that rather that let's say the minor cost is the main thing, now it is making sure that supply chain keep running, because many of our customers have now realized that supply chains are more about availability and making sure that you can continue to serve customers rather than only having minimal levels of minimum cost.
Does this make the just-in-time promise that so many companies were trying to offer less of a possibility or even a desired outcome, and more just the resiliency and the ability to be flexible, much more of the priority?
I think it's exactly, it's the availability of products, which becomes far more the priority than purely the just-in-time, because what we all have learned is that the cost of a disoptimized supply chain because of an event is way higher than having a 5 or 10% lower or higher stock level. Now, obviously, with today's interests, stock levels have become obviously more relevant to reduce those. And that's, I think, where also the whole element of data analytics, converting into AI, converting into generative AI, come in as well, to make sure that we plan supply chains real time, better and better, on the use of data and also on the use of historical data. And there's a lot of historical data in the past 4 years that helps us to learn how you can respond to things.
What makes shipping so complicated is because Secretary Pete Buttigieg talked about this yesterday. There's no like air traffic controller like there is for flying when it comes to logistics, when it comes to shipping. How can technology change that to make it more transparent?
Well, when we talk about port control, there actually is. So, for instance, in ports, there is a traffic control and a connection between the ports. So I think in shipping, it's more advanced than it makes it seem. And I think some of the elements that you could see in this event as well is that they have been able to respond pretty fast to avoid even more dramatic events because of a good communication that there was. So, but you're right, the use of data is fast evolving. And one of the things that you see in general in the logistics sector is that the amount of investments that goes into the sector compared to 4 years ago is exponentially more. That means that the amount of innovation in the sector is exponentially more. And that you see that in data, in what we can do with data and what we can do with data analytics. You see that in robotic solution and other innovations. So therefore you see a fast evolvement. I would say internally, I always say that if you look at the last 4 years, the speed of innovation in the logistics sector compared to the 10 years before is mind-boggling. So it is. So that is actually which helps us to further increase and improve compared to the airline industry, where you see the opposite.
When you look at the communication between the government, Pete Buttigieg again today, I mean, being shippers and supply chain logistic partners, how has that communication been between the public and private?
In these type of events, I think the collaboration between public and private, well, if you take, for instance, the example between ports, because ports is in some cases public, some cases private, some cases the mix of both. I think there is a good interaction, but I think if you look at the speed within which that has evolved on the business side, so for instance, now the interactions with companies is far more on sea level than where that before would be 2 levels down. Because CEOs and CFOs of our customers see the importance of being very close of what's happening in supply chains, because that's a differentiator in your profitability, your market share, your growth. I think gradually governments need to make that same step to make sure that to understand how important it is for the success of the economy to really be close to the infrastructure, and that's not only hardware, but it's also software, and those investments need to come from there as well.
You talk a lot about building out resilience. When we look at supply chains, particularly over the last few years, things feel quite fragile. From your perspective, are things more fragile or more resilient over the last few years, post-pandemic?
I think to use different words, I think the capability to respond to the unexpected has evolved enormously. The only problem is that the unexpected happens more than in the past. So I think it has improved a lot, and that is because of bigger investments, the view of necessity of having those capabilities. But on the other hand, the number of events is evolving faster than the development of the sector. But I must say, if you look at if I talk about DHL, but if I also talk about the market in general and our customers, the capability of responding to things has evolved enormously.
So does that mean that you're able to charge more and that shipping will in general cost more because building in resilience is expensive?
Charge more and cost more are 2 different things, right? Because I think what you see is that because the professionalization of the sector has evolved, and therefore the value that it brings has evolved. So it might be that there is a higher price to pay, but actually the benefit might also be higher. So that doesn't necessarily translate in higher cost, because the efficiency might be improved as well.
Oscar, thoughtful stuff. It's good to see you. Thanks for the update.
Thank you.
Oscar de Bock there, the CEO of DHL Supply Chain. Equities at the moment negative by 0.1% on the S&P. For an update of stories elsewhere this morning with your Bloomberg Brief, here's Yahira Hakez. Hey, Yahira.
Hi, John. While UBS cut its bonus pool last year by 14% after a tough year for traders and deal makers, its CEO now ranks as the best paid European bank boss. Sergio Aramati received $15.9 million in compensation for his first 9 months in the role. He was brought back as CEO in April last year to oversee the bank's rescue of Credit Suisse. UBS reported a record annual profit of $27.8 billion, largely driven by windfalls from the takeover. President Biden is set to raise $25 million in a single day as he campaigns across New York City. Biden is raising money alongside Barack Obama and Bill Clinton at a Radio City Music Hall event. The effort is designed to help expand Biden's already large cash lead over Republican presidential candidate Donald Trump. The showing alongside two former presidents giving Biden an institutional backing that Trump lacks due to his estrangement with big GOP names. The White House will require federal agencies to test AI tools for potential risks, plus designate officials for oversight. The Office of Management and Budget issuing a government-wide policy pushing federal agencies to implement safeguards by December 1st. The policy includes protections against privacy violations, discrimination, and more. Examples include giving travelers the ability to opt out of TSA facial recognition and allowing human oversight when using AI to root out fraud in government services. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Governor Waller with one message.
No rush to begin cutting interest rates, no rush to cut the policy rate. I see no rush in taking the step of beginning to ease monetary policy.
There is no rush, apparently. That conversation up next. This is Bloomberg.
I was around so many powerful people in my entire life, from the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Slightly negative, lower, down by 0.